customer's life. It usually matters who they sell it to. And there's a lot more details. It's not just a price. It's not just a number. They're probably selling you their family, all the people that they work with day in, day out. And so it really matters who is on the other side of the table. We're going to focus on asset sales. There's two ways to buy a business, which you're going to learn later. It's an asset sale or a stock sale. Since a lot of you have been involved with the PPP, the Paycheck Protection Program, the last few weeks, everybody probably knows now what form of ownership they are. This workshop relates to businesses which are going to sell for between $100,000 and $10 million. We're not talking about the $50 or $100 million sales. That's a different workshop, and a lot of the things are the same, but it's not the same too. And we're going to focus on sales which are SBA financeable. This is, as I mentioned, a really changing part of our universe, but it's the laws of physics and it applies. Okay. So I'm going to set the stage, talk a little bit about what the world's like right now. Talk about what you actually buy when you buy a business. The first question everybody has when they come to us is, what's my business worth? So in one afternoon, you're going to become experts in business valuation. Now, if we get 10 businesses in the same industry and look at their financials, we're going to see that they all will look different. And so we are going to show you how to go through your financials to do an apples to apples comparison. So if it's a C Corp, if it's an S Corp, it's a sole proprietorship, how to show you to make those financials look the same. We're going to show you how to finance a business purchase. I'm going to tell you the difference between this stock and asset sale. One of the craziest things about business sales are, in an asset sale, you do not know what your taxes are until you negotiate it with the buyer. Sounds crazy, but it's true. And so that's a really important part of this. And we're going to talk a little bit about what's happened the last month in our universe, the COVID considerations, where we are, where we might be going, and then wrap her up. Okay, let's get started. Setting the stage. Okay, so we took our show that we used to have, and we decided to show you what we said and then go from there. So 3 weeks ago, this is what we would have said. Bank financing is plentiful and relatively inexpensive. Okay, that's true. And that has not always been true. Go back to the recession. In 2009, I had a really nice company for sale, a software company, and the tax returns had $500,000 net profit on it year after year. When it came to lending in 2009, a lender came to me with a proposal to lend $20,000 on this business, which was half of the liquidation value of the assets. That didn't work. Anyway, shortly thereafter, about a year.
Suzanne, this is Kim. You broke up when you were explaining what that lender said about that business.
Okay. Don't know what to do with that. Thanks, though. Anyway, for those, I'll repeat that. So the lender wanted to lend $20,000, which was half of the liquidation value of the assets, which were a bunch of computers. Okay, so that didn't fly. About a year and a half later, we were able to get a 7-figure loan on that business. So bank financing is not always available. People got a little complacent and thought it's always here, it will always be here. It's not like home lending. So that's why it's important to hear what our lenders have to say today. we had felt that consumer confidence was kind of peaking. We were at the end of a bull run. We'd had a long era of prosperity, but Colorado was still outpacing the nation. We were seeing a little bit of changing market psychology, and we thought things would change. We used to say interest rates were rising, but then they went down. They were in flux. We were seeing some sales softening, but we were still very optimistic. And the words we got were our economy still had a couple of years of go-go juice in it. Now, but not necessarily tomorrow, today, the bank financing is in flux. Consumer confidence right now is probably at a low point. The economy is on pause. The market psychology is unknown. And things are changing. Some will be better when we come out of this, and some will be tougher. So this is our prediction, our crystal ball. We will return to a new normal, and we've been through this before. We've been through the dot bomb. We've been through September 11th. We've been through the recession. Locally, we've been through the floods. All of those were major disruptors, but we always came back. The laws of physics and business sales will prevail. Okay? So this is a day in the life of a business broker. We meet with a seller, and from their perspective, they have just a fantastic business. They're extremely proud of it. And, you know, it's a reflection of them, blood, sweat, and tears of their lives. They typically spend more waking hours with their business than they do with their family. So they come into us and they want a nice price. Then the buyer comes in, and the buyer sees it a little differently. Every business has warts. The buyer can find them more easily than the seller. So the buyer has a more conservative view of what the business looks like to them. So then they start talking to their family, friends, lenders, and we're giving you guys a lot of grief today, lenders, but this is what it looks like to them, because they're able to point out all the reasons they shouldn't do it, etc. But everybody's seeing something different. And then the last vantage point is the tax assessor. They think it looks really great. So what we've got to do in a business sale is get everybody looking at the same thing. So let's start with talking about, why would anybody sell a good business? Okay, people say that to me, and we sell plenty of good businesses. So sometimes it's just time in your life. You've worked hard, you want to retire, you want to do something else. Most business owners historically keep a lot of their wealth in all the eggs in one basket in their business. So some of them want to take money off of the table. And there are ways that you can stay with your business if it's large enough and appeals to the right buyer. You can stay with it, take some money out now, stay with it, run it, and then get what they call a second bite of the apple later. It's called a recapitalization. Call us if you want to talk about it. Life changes, new businesses come up, new opportunities. We recently met with a guy who was he had a tech business, and it was a really nice business. But he was the kind of guy that liked to start businesses. He was bored with the mundane running of day to day. He had all kinds of other ideas that he felt would enable him to make more money and do a lot of cool things. So he sold a good business because of that. Sometimes we run up into some people who are very astute and understand that they don't have the skill sets to take that business to the next level, or they don't have the money. That's a good reason to sell. Health and retirement. Retirement, great. Health reasons, not so good. We have what we call the D's in business sales: the death, divorce, disillusion, disease, deficit. And a lot of times people come to us later than they wish. Was talking to one of our former sellers recently. He's not doing well. He said, boy, do I wish I had sold earlier. And the takeaway from this is sell your business while it's doing well and while you are doing well. Okay. So people say, why should I buy a business? I can just start one. Okay, that's true. And we find those are two different people, really. Some people love to start businesses, and some people understand the benefits of buying an existing business. The biggest one is it's usually making money right away, or even it's a seasonal business, it will be soon. And you know, when you start a business, you're hoping and praying that it's going to work. You don't know how long it's going to take to make money. So that's one of the biggest reasons to buy a business. There's also embedded knowledge. The seller has run this business. They've tried different things. They know what works. They know what works in their market. So you take it, you know, you get the benefit of that. Lender or seller financing can be available. We're going to show you today how you can leverage your money with the right business sale, how you can be making money immediately, get in for really a fraction of the price. It can be a real win-win. A lot of times the down payment is below what it costs to actually just set up this business and open the doors. And then you've got to wait for customers to come in. So business sales are all about risk, and it's quantifiable risk. And so, yes, we all take risks every day. You take a risk going outside today more than you used to, but you can kind of figure out how, you know, what's the risk profile and can I live with this? You also have the potential to improve the business. Don, I'm thinking about a sale you had not long ago. The owners were a couple who were getting up there in age. They'd had the business for a while. They were very comfortable. It was making them about $10,000 a month at the time. And they weren't, you know, doing any marketing or anything. We ran into a young guy who had experience in the industry. He had a lot of energy and enthusiasm. This guy had to hawk his beloved motorhome to buy the business. It was painful for him. But he started marketing, doing a lot of different things. He had contacts in the industry. Within 6 months, he was making $50,000 a month. Today, he is driving a much nicer motorhome. So that's a win-win, nice story. No questions so far? Okay. Okay, this is why you really buy a business. So these are long-term rates of return for different investment categories. So starting on the left-hand side, we've got money markets that are giving you sub-inflationary rates, bonds, real estate, stocks, middle market businesses, and small businesses. This is kind of the food chain here. And these are 80-year long-term averages. You may disagree at one particular time, and you know that it doesn't return this way, but it will. So the blue is kind of the low end of the expected return scale, and the orange is the high end. So if you note in the small business, the very right-hand column, it's got the highest return, but it's also got the highest variability. And so that's where you can influence it. If you look at it, the returns are expected to be between 25 and 100%. For the mathematically oriented, if you take the reciprocal of that, that's a 1 to 4 multiplier. That number is going to show up later, so pay attention. So when a buyer or a seller comes into us, they've got, a lot of them have an idea in their minds on what price they want for the business. So when we look at it, for small businesses, closely held businesses, businesses that the owner is probably going to work in, they need, first of all, a return on their time. This is their job. This is how they earn a living. So not like a house, which we've seen house prices have gone crazy. Businesses prices can't go crazy unless the business is earning a lot of money. So the seller expects to take a salary out of the business. So there's a chunk of change. And then a business is an investment. And any investment you make, you've got an expected rate of return on it. So they expect a return. Most of the people that we work with leverage it. They borrow. And we've got some great ways to borrow money through the Small Business Administration. But the business has to support that debt. So we look at all these factors when we're valuing the business. Oh, what's middle market? Okay. We are talking in the price range, the 100,000 to 10 million is what they call the small business range. There's a term, Main Street, which I don't like, but it implied that they were the businesses you would walk down the street and see. Middle market are the larger businesses, the ones you read about in the paper where some strategic acquirer is buying the business for a bigger price. It's usually 10 million on up and 10 million maybe low, but it's the 10 million to $1 trillion price range. The difference is most of those businesses aren't purchased by individuals. They're purchased by strategic acquirers or private equity groups or publicly traded companies. Okay. So when you go and you sell your house, you typically expect cash at closing, and deals are usually negotiated that way. Business sales may or may not be all cash at closing. So let's talk a little bit about that. Okay, deal structure is as much a part of a business sale as is the price. And the seller, this is sellers where you should pay attention. You have the ability to influence the deal structure significantly. I'm sitting down. Normally, if I were standing in front of you, I'd jump up and down and say, clean books and records, clean books and records, please. Use a professional accountant to do your books and records or to do your taxes and position your business. There's a lot of things you can do to position a business to sell better. We're working with a business right now. They came to us about 2 years ago, and we looked at it, and it was a B2B service company, but they had a retail storefront and then a very large warehouse behind them. We estimated that they had maybe 4 times the space that they needed. They ended up moving the business. They had to prove that they were not a retail business. They kept saying, yeah, our customers aren't retail really. The people that walk in the front door don't usually buy. But that's a risk factor for a buyer. They don't know if they could believe that or not. So they moved the business. They cut their rent by 75%. They didn't have to be there staffing it because it was a retail type business. So they cut the hours they were working, and we estimate that their business value went up between 2.5 and 3 times in that period of time. So that's proper business positioning. I'd like to tell you a story about clean books and records. We were working with a business, and they bring in their October statement a couple of years ago, and it looked great. We're like, wonderful. And then they gave us their December statement, and their sales actually went down. I'm like, how does that happen? Well, turns out the seller of the business turned it over to a manager, and he went and spent 6 months of the year on the beach in Mexico, wasn't really paying attention to it. And it was a project-based business. So this manager, not very educated in accounting, every time he went out and bid a job, he put it down as a sale. And then at the end of the year, he just pulled the ones out that he didn't close on. we had a lot of egg on our face. We were very embarrassed because we had presented this to prospective buyers. It would have come out in the due diligence, but still. Anyway, the other thing that buyers come in and tell us is this business is the seller. If the seller walks out the door, there's not a business there. So sellers, anything you can do to prove that the business is not reliant on you, the better. Had a nice sale a few years back, and the seller actually took a year off and traveled around the world, and the business held. He did a lot of things to position it ahead of time to make sure it could do that, but that was proof. So every seller that comes into us, virtually all of them want an all-cash deal. And maybe you can get an all-cash deal. It might cost you in the long run because the buyers that you're working with, if they can go out and take their money and leverage it, they can buy a bigger business. And if they're buying a bigger business, it usually means it's making more money. And so they're going to do that. So often there'll be a price, but if it's all cash, it might be a low price. This is where the SBA comes in and what you're going to learn. For businesses that position themselves properly and have the right tax returns, they can get a very high level of cash, sometimes all cash at closing. I'm going to show you how that works. So if you go on the internet and you start reading about buying a business, you're going to read that if a seller believes in their business, they will carry. Now, I don't believe that. I believe if the seller believes in their business, if a seller believes in the buyer and they're forced to by the buyer or the lender, they might carry. So the buyer and the lender like it because the seller has skin in the game. If something goes wrong, the seller's likely to come in and try and help them. Even if you do succeed in getting an all-cash sale, expect there to be not all of it to be transferred at closing. As opposed to real estate sales, there are some taxes, sales taxes, payroll taxes, other things that follow a sale. And also the seller has to train you on the business. And so usually they're going to require that that money is held in escrow for some period of time, or that there's an offset on the note before you will get your entire amount. Tax management is another reason you might want to carry. So depending upon the structure of your deal, you may not have to pay taxes on part of it until you actually receive the money. This is where you want to ask your accountant. But we've seen sales where we close on December 31st, the seller gets so much money, and then there's a note due January 1st, the very next day, because it's in a different tax year and it put the seller in a different tax break. And as you're going to see, creativity is required in business sales to make it work. There are all kinds of scenarios. You know, what if you just lost a major account? What if you just started a new business division and you haven't seen the results of that yet? So every business is unique and we address the situations at the time. So remember the houses, everybody was looking at a different vision. To successfully accomplish a business sale, all parties have to have the same vision. So here, shared vision. Are we seeing a 6 or a 9? We gotta get the same number. Okay, it is time for me to introduce Don Hobbs, my colleague, who is going to take it from here. Let you say a little bit about yourself, Don, and go from there.
Hello, everybody. I am Don Hobbs. I'm a 5-year broker with Front Range Business. Started and sold a few companies in my past history and have been a resident of Boulder for 49 years. So this is Boulder and Denver, my community, my area, Longmont and all the towns around. And that's where we'll go with that one. I love the outdoors. I'm a bicycle nut. So what I'm going to cover here is the elements of a business sale, those things that are part of pretty much every transaction that happens. There's a number of key things. So you see the box here. Be nice if we could box everything up into a business sale and put it in a nice cardboard box like that. We can't. So let's break down on the next slide the 4 key things that you're actually looking at in that box. One is real property interests. Real property is where you do business, and that could be leased or owned. Tangible assets, personal property. Those are the tools, the equipment, and things you use. Goodwill, intangible assets. We're going to spend a lot of time talking about goodwill, but it's those things that make your business successful that aren't the real property or the tangible assets. They're those other components. And then there's working capital, which is the money required to operate. So let's dig into those a little bit and kind of take them in order. Let's start with seller owning the real property. And in this particular case, the seller owns it. So often in a business sale, you have a seller who owns their building. And now as they go to sell their business or buildings, they're presented with options as to what to do with the building. So one of those is to sell the business and the building to the buyer. And for that, you're going to want to, the seller will want to get an appraisal of the real estate from someone who's qualified to do that. And now you're going to know what that business will be worth. We'll talk a little about that. Another option is to keep the building and say, I'm going to keep it and I'm going to lease space to the new buyer. Why would you do that? Well, one is it gives you a continuing income stream. We often hear people, that's my retirement income. That's what I want to be able to do since I've paid for the building. Now I'm going to be able to keep the proceeds from that. And often, of course, it's going to take looking at that lease and saying, what has the previous owner been paying to him or herself? And what is the appropriate amount of a lease? And that's often, by the way, going to come from getting an appraisal of the building's worth and working backwards into a lease amount that is appropriate. A third option is to sell that building on the open market to a third party. Ultimately, that becomes very problematic. For the buyer to buy the business, typically with an SBA loan, they're going to need the right to occupy the premises for a period of time equal to the length of their SBA loan. So if that's a 10-year SBA loan, they're going to need a right to occupy something similar to those 10 years. If that's the case, then you've now encumbered the sale of the building by establishing a lease rate, which is going to define the value of the building going forward. That may not be on the open market what it could be worth. At the same time, if you go in and try and sell the building first, then that new owner of the building, new third-party owner, is going to look at what they've paid for that building as the determinant for what lease they should charge. And that may be substantially higher than the current owner has been paying, and therefore the profitability of the business will change. So anytime there is property being sold along with a business, or in some way it's altering the value, just keep in mind that the profits of the business will need to be normalized to reflect what's changing in terms of rent or cost of occupancy. Another possibility, we'll go into the third-party landlord on the next slide there, and that is if there is a third party, it wasn't owned by the seller, it was owned by someone else, then you're probably going to have a lease with that building owner. And so to get that done, the seller and the buyer will want to jointly approach the landlord to communicate that there's going to be a change in business. Many landlords have the experience of businesses being sold with them. Some who only own a couple of properties may have less experience with that, but they're typically prepared to do that. And it can be important to involve the landlord early. And the primary reason to involve the landlord early is the amazing amount of power that that landlord actually wields in terms of the ability to get the business sale through. You need to find out from that landlord, is the landlord going to accept the new buyer? We'll probably want to see financials. Does the landlord have other plans for that building, perhaps to consolidate 2 spaces and give it to a tenant? And so you need to get in there and, as part of the early stages of evaluating the transaction, determine what opportunity you have. Sellers, be advised, you more than likely will have a lease term in your contract that's going to say that even if you assign this lease to the new buyer of your business, you're going to be required to stay on as a guarantor. That can be negotiated out, but it's important, and reminds me of a specific example we had back before the previous recession, 2008. We had a person who was opening up a restaurant, buying into a restaurant, and needed to have someone of substantial wealth sign as a personal guarantor on that restaurant. Unfortunately, the restaurant didn't succeed. There was a substantial amount of time left on the lease. And when a new restaurateur came in and took over the space, that restaurateur would only take it over if it could be taken over at current market rates, which had dropped $5,000 a month. So there was a $5,000 differential times 12 months, 60,000, times almost 5 years, 300,000. In essence, that wealthy individual, because they were a guarantor and could not get off, was forced to subsidize $300,000 in lease payments. So be advised as sellers to work very, very hard at getting off of liability. Often landlords will let you off after, say, a year or 2 of the new owner successfully paying rent. Anything you can do to limit that is worthwhile. And long-term lease needed for SBA, which I said. Leasehold improvements. So you have a third party that owns the building. You've needed to do various things, whether it's bring in extra electrical, or you've had to build in point of sale type shelving and things to decorate. You need those for your business operations. You pay to have those put into the building. But keep in mind, at the end of the day, those ultimately belong to the landlord, not to you. And they will likely transfer in the transaction to the new owner because they can't be removed, but they will continue to belong to the landlord. So always keep that in mind. And, this is just a generic statement down here about lease terms are always important. But lease terms are, I would put lease in one of the 5 most important things to pay attention to in any transaction. It's not a secondary element at all. Let's go from real property to tangible assets. So tangible assets, that's the second part of what every business transaction includes, second element. And so these are your furniture, fixtures, and equipment. Almost all businesses are going to need something. Even if you're a computer-based businesses, you need computers. But imagine you're a group that works in the field. So you have trucks and you have truck equipment and you have radios. If you're a retail store, you have displays and racks and other kinds of equipment. If you're office and retail, you may have cubicles, things like that. There's often vehicles required with any business. So these are your tangible assets, the physical things that can be moved around. That's the way we think of them. They're things that can be moved around. They're not what you sell, but they are tools that you use. Inventory are the things that you sell. Many businesses, if you sell goods, or if you sell services that require some consumable goods to deliver, for example, a cleaning business might have an inventory of cleaning products that are consumed as they do their work. So those are typically included in the price of the business at the cost that they were purchased. If you're a retail store, you don't include your inventory at the retail price, you include it at the wholesale price, the price that you paid for it. And it is very, very important that inventory be both saleable, meaning it's current and it's what people want to buy, and appropriate level. I got just a couple of examples, I think, to talk about that in terms of saleable. Just in the last year, we sold a business, distressed business, which made textile products. And in going through and looking at the financials, there was about $700,000 in inventory that was on the books. And in fact, going to the facility and looking at it, the inventory was absolutely everywhere. And a lot of it was old. It was inventory that really would probably never find its way to market. And so that inventory could not be included in the sale at $700,000. In fact, it needed to be included much, much less. First step was to write the inventory down. We'll talk a little bit about that in a minute. And then when the business finally sold, the inventory was actually negotiated by the buyer down to $150,000. So from $700,000 on the books, there was really only $150,000 in productive saleable inventory there. Another example is appropriate level. So you want to be able to do, they talk about the number of turns in a business, turns of your inventory. Every business is a little bit different. But we had a business that was a specialty retailer. They had an inventory over $1 million, but they sold clothing. And one particular item that we just happened to count and recognize was completely out of whack was they had 27 pairs of the exact same size and model of pants, which they sold about 2 a year of. So that means they had 13 and a half years worth of inventory in that size pant. And that's an example of, having the appropriate level. Buyers will come in, they'll want to look at the sales figures, they'll want to understand how much of this inventory will I be able to sell through in a reasonable period of time. And that's part of any analysis, due diligence analysis on any sale. So just a couple of things to pay attention to in terms of tangible assets. And then at the bottom of that slide, you'll see that we've put in bold the statement, assets exist to generate income. That's a statement that I'll be making and others today over and over again. People often think, okay, here's the price for my business, $200,000. Now, what are my assets worth on top of that? And the answer is nothing. The reason you have those assets, the furniture, fixture, equipment, and other assets that you have in a business are so that you can either make the products you make or sell the products you sell, or perform the services you perform. And that is all. The fact that you have those assets is baked into the profitability of the business. It's really not an additional element. And so it's important, just as with inventory, it's important with your equipment, that you have productive equipment and that it is working for you as best it should. So assets exist to generate income. Some businesses have a penalty that requires more assets to make the money that they make. Other businesses can get by with less. But in both cases, the value of those assets and the amount you have should be already baked into the profitability of the business. Okay, let's move on and look at goodwill and tangible assets.
Hey, Don, I'm going to go back because we had a question.
Yes.
Somebody asked, could you explain a little bit more about seller remaining liable as a guarantor on the lease means?
Explain a little bit more of that, yes. So if you look in almost all leases that you as the seller have signed, you're looking for a clause relating to the assignability of a lease. And that clause probably has very nice language, things like landlord will not unreasonably withhold permission to assign this lease to a qualified buyer. So you say, oh, that's good, they won't stand in the way. And then it will have other clauses after that. So one is probably notwithstanding the assigning of the lease, the seller remains liable for lease payments throughout the remaining term of this agreement. And that is written right into the lease. So if your lease has that, that becomes your starting point for a negotiation. That landlord already has their hooks in and is saying, if the new buyer does not pay, and if the new buyer is operating under an assignment of the lease, then you become liable for that. And is that answering the question, Suzanne, as you heard it?
I think so. Whoever asked the question, if it didn't, please let us know.
Yeah.
Yes, it did. Thank you.
Yes, it did. Okay, very good. And so that's one component. I will mention, I saw a lease recently, and the lease said, landlord will not unreasonably withhold assignment of this lease. And then the next term was, any person who would receive this lease on an assignment must have net worth equal to or greater than the current tenant, the seller. Well, it happened that the seller had a pretty high net worth, and there was no way a buyer was going to show up that had the same net worth as the seller. And so right there was a clause in the lease that made it very, very difficult to transition it. So again, I'm trying to emphasize, landlords have a lot of authority and a lot of power, and it's really valuable to get into your lease early and understand it. Okay, moving on to goodwill and intangible assets. This is the best, simplest sort of description of what goodwill is. It's the difference between the price of a business and the value of the physical assets. So we've talked about the physical assets, the equipment and leasehold improvements are physical assets, and they have some value to the new buyer, but the seller is probably going to expect, and the business is worth more than those. The difference, let's say the physical assets are worth $100,000, but the business sells for $300,000. The difference between those, that $200,000, is goodwill. And goodwill is a very, very important component because what you're saying is the ability to make money. And all of those assets exist to generate profits. Those profits are what you can sell as goodwill. And so they're important that way. I think one of the important things to recognize about goodwill, and also to recognize our lenders who are on with us today. And maybe I can have Arvind in just a minute comment on this. I'll tee you up, Arvind. And that is that the SBA Guaranteed Loan Program, which is what most buyers will go to, is a loan program that allows a buyer to borrow based upon goodwill. And Arvind, would you be able to add any additional information on that?
Absolutely. Thanks, Don. How I would phrase it actually, and again, every bank has its own kind of policies, but if I were to compare, say, an SBA loan with a conventional loan, in the conventional world, we look at assets. So we look at hard tangible assets, real estate, ARs, receivables, other types of maybe inventory, and then we margin against those assets. And typically, we will not take goodwill into consideration if we're looking at it conventionally. And the nice thing with the 7A program, the SBA 7A program, is that the SBA guarantees 75% of the loan to the bank. So banks are willing to take a position on goodwill and financing assets that are not tangible per se. In many situations with business acquisitions, you have that component. If businesses are doing well, they're trading typically at a profit or running at a profit, they're able to generate some goodwill on that transaction. And that's exactly what the SBA 7A program is set up for, to be able to help banks finance that component with that additional government guarantee.
Great. Thank you. By the way, Arvind is with US Bank. He's one of a few lenders that are on today's program with us to offer their insights. So thank you, Arvind.
Hey, Don, there is a question about amortization of goodwill. This person on the workshop is ahead of us. We're going to get into that later, so just want to let them know.
Okay, great. Yes, we will in fact be talking about amortization in just a second. So what are these intangible assets? Well, there are a lot of different things. They can be reputation. You can't really quantify reputation. Customer lists, trade name and trademarks. Maybe their business has patents and intellectual property. Might have a very, very effective website and social media program. All of these things, experienced employees who can operate the business well, might be in a very favorable location compared to its competitors and have some advantages there. Systems in place and profitability. All of these intangible characteristics of the business are things that lead to its profitability. Those are benefits that the business has. That creates the profitability, which is the last term on that bullet list there. And that profitability is really going to drive a lot of how the business is valued. So, but there is a category, and you'll see it when we do a valuation itself, called goodwill, and it will be part of contracts. When a purchaser buys the business, there is one of the allocations of the price is to goodwill itself, and we'll be looking at that as we move through the program today. So goodwill, and by the way, I'll just mention one other thing on that with respect to the customer list, and that is that again, we use examples of different deals and that we have been a part of in the past because they become good examples and ways to understand this. Customer lists in particular, we had a cleaning company and they wanted to sell their business, and they had, in essence, handshake agreements for their commercial cleaning business with everybody. They just said, yep, we'll come in and clean, and didn't have any contracts or anything. And they came in and we looked at that and gave them an idea of what their business might be worth, and said, one of the concerns we have is there's a lot of risk associated with the lack of contracts with your customers. And the original discussion was, well, gee, I don't know if we can get them to sign contracts. I said, well, if you can, then you're going to be able to show the buyer that you have these contracted businesses. that are planning to do work with you for a longer period of time, set it up as an evergreen renewal situation. And sure enough, they went back, and surprise to them and even surprise to us, they were able to get 100% of their customers under contract, and it significantly increased the value of that business out in the marketplace. So again, it was the presence of a contract, which is a goodwill, intangible asset, increased the value of the business. So those are always things to be looking out for as you go through. Okay, understanding goodwill a little bit better. Goodwill, that ability to make money, so you get a return on your time as the owner, you get a return on your investment, and what drives it is going to be the likelihood of future income and the replicability of that income. A buyer is going to look at this through the lens of, I understand the historicals, what's the future opportunity for me down the road, given the assets that are in place and the investment I'm going to make, take that over. And to use an example of a declining likelihood of future income, when was the last time you were in a video store? And just 10 years ago, Blockbusters were everywhere. So, you know, businesses do lose their ability to generate income over time. Technology shifts and industry shifts can make that happen. So looking at the next one, simply put, goodwill is the means to make money. Assets are the tools used in the process, which is why we reinforce that assets exist to generate profits. And those assets can be tangible, they can be intangible, but they exist to generate profits. So assuming you're using your assets effectively, they are leading to the profitability of the business, all things being equal, and therefore you're being rewarded for your business based on the profitability, not just assets that you might have. Okay, working capital is the fourth element of a business sale. And working capital, simply put, it's the money that is required to operate the business. And so working capital, businesses are sold as asset sales or stock sales. Suzanne's going to go into that in a little bit. In an asset sale, which is the most common sale that we do, the working capital typically does not transfer in the sale from the seller to the buyer. So the things that would be excluded, for example, if there's cash in the bank, the seller keeps that. If there are accounts receivable, those go to the seller as they're collected. If there are accounts payable at the time of closing, those are all to be paid off by the seller. The seller will get back any lease or utility deposits they may have put in. They have to obviously pay all of their payroll up to the date of closing and the taxes. And if they have any debts or other liabilities, it's the seller's responsibility to pay those off. In other words, the buyer is going to get a clean slate, but all the previous working capital and its components will stay with the seller. Now, it needs to be calculated for each business. And there can be businesses that need very little. A restaurant needs very little working capital because every day they're cashing out in that business and receiving all payments. But if you're a manufacturing business that has to make products, warehouse products, ship products, and only then get paid for them, you're going to have a much larger working capital requirement. So each business needs to look at what that is. Why is it important? It's because a buyer needs to not only bring the price of the business to the table, but the buyer needs to bring the amount of working capital that's required to do that. And if I could, is Renee Wood on? Did I hear that?
I'm on.
Renee, can you talk a little bit about how, as a lender, you handle working capital?
Yeah, certainly. Thanks, Don. Every lender is going to take a look at what the needs of the business are, and depending on the type of business, if their payment terms are 30, 60, 90 days, then a lender is going to be looking at working capital on hand for maybe 90 to 120 days to ensure that they've got sufficient operating capital to get them until they receive payments. I mean, everything is it's deal by deal specific, but one thing that's very critical is understanding what the monthly operating expenses are plus what the payment terms are if it's not a business where you're getting cash daily. And that's something that the buyer would work very closely with their lender and their CPA to ensure that they've got that sufficiently covered. And buyers of a business have a couple of options. You could add working capital into the loan to be advanced the day of closing. There's also some options where some people like to take working capital in the loan and also have a separate line of credit available to them to tap into should they need it. So lots of options. Just know that you'll be talking with your lender and your CPA about all of these items and as you move forward.
Great. Thank you, Renee. I appreciate that. And let me just point out one more thing on the slide. We talked about working capital not being included. There are a couple of times where it's important that working capital is dealt with in the transaction. So one is customer deposits. Customers often put money up front for services or products to be delivered later. Work in process is another one. If it's a manufacturing or a business that incurs a lot of costs prior to being able to invoice their customers, you have work in process. The seller should be compensated for the expenses that they have incurred along the way, even though it might be, think of a car that's 50% built. There's certainly an amount of value in that car that should go to the seller. The buyer will do the rest of the work and receive the money. So that needs to be taken into account in terms of a transaction. And, you know, there's a number of stories on this, but again, just by way of an example, we did sell we're working with the selling of a wedding venue who had taken $500,000 in the off season for weddings that were going to occur in the summer. And they didn't understand why they should have to give up that $500,000 to the buyer, even though the buyer was going to have to absorb all of the costs of running the wedding. And it became a big sticking point. So getting an understanding of why that money came in, what it's for, and whose property should it be at the time that the business transaction takes place. Very important negotiation, very important calculation, and it's going to vary. Okay, so that takes us through the elements of a business sale. What is in there? There's 4 components: working capital, goodwill, real property, and the physical and the intangible and intangible assets. If there's any questions, we can go to questions on that, or we can move on to where we step into the area of business valuation. Suzanne, you can let us know if it's time for a break.
There are questions, Don.
Okay.
The first one is, can you ask the seller to include the AR for the buyer in the sell price? Is that common?
Yeah, absolutely. You could have the accounts receivable. You calculate the accounts receivable. You could ask the seller to leave those in. That is a reduction in the net proceeds to the seller, and the seller might want to have an offsetting value in the price for that. But it can be a way for cash flow to come into the business in a short term, as opposed to longer term paying off a loan.
There is another question, Don. Are the loans guaranteed by the business only?
I'm going to, we have a third lender on, Suzanne, and I apologize for not knowing the name of that third lender, but maybe we could get that lender, SBA lender, to come on and talk about SBA loan guarantees.
That's Vic Callender with Central Bank Corp. Are you out there, Vic?
Vic is here. Thanks for including me, Don.
You bet.
Bottom line is SBA is pretty hard and fast on getting personal guarantees on SBA loans. So yes, the person should expect to have a personal guarantee, and they should expect that their home will be considered as collateral.
Great. And Vic, just so I know if I'm asking, as a lender, the guarantee is from the SBA, but what do you consider as a lender your responsibilities in terms of making sure, even though the loan is guaranteed, that you're going with a loan that you believe is sound and is backed up?
Yeah, we typically are going to look at cash flow as well as collateral, but we don't deny based on collateral shortfalls. So we know the SBA is going to give us a 75% guarantee. So we are looking at that number and then looking for cash flow to repay the debt. So, we're not going to be that far off there, but as one of the SBA rules says for eligibility, if they can get credit elsewhere, we cannot do it. So I always say to my client, if you don't like those terms, then you should be able to get a loan somewhere else.
Great. Great. Well, I think what we repeat over and over again, it goes for all the lenders that are on today. And by the way, if there happens to be a fourth lender or fifth lender that are on, if you would just message Paul in the chat feature so we know you're here, we're always more than happy to bring you in and get your good insights. I think the thing with SBA, I always want to make sure that sellers and buyers understand, and I'm not just being nice to you guys today, but the SBA lenders are your best friends. They're going to do a couple of things. Number one, they're going to give the whole deal the sniff test, and they're going to make sure that there's enough cash flow in there to be able to pay off that loan. Most borrowers are buying that loan to support their lifestyle. So they're looking for that. They want to make sure that not only can the loan get paid off, but that the person who has bought the business can afford to live according to their lifestyle. So they're doing some great analysis to support that. And that's, one of the key things. And they're also looking to see that a buyer is qualified to step into a deal. They ask for the buyer to put together a business plan, and they go over that with the buyer. And again, those are things that help make sure that not only does the transaction happen, but that there is a continuity of the business afterwards because the right parties have been brought in. So everyone should think of the SBA lenders as positive components putting together a transaction.
Hey, Don, there's also seller notes. So would you answer the personal guarantee on the seller note issue?
Yes, absolutely. So seller notes are going to also include a personal guarantee. The difference for the seller is the seller note will be subordinate to the SBA lender, primary note. And so they will not get their money until and unless the SBA is getting theirs. There's a couple things that could be different. Whereas the SBA note loan will start having repayment immediately. One of the requirements the SBA may put on a seller note is a 1 year or 2 year or even longer standby for the seller to begin to receive payments. The goal of that is to make sure that the owner is landed, the new owner is landed on his or her feet, is capable of running the business, maintaining the cash flow, and paying off the note. So there can be a delay for the seller. They can receive and collect interest during that period. The seller is also going to put a can put a personal guarantee on their note, absolutely, the same as a bank. And they can put a life insurance policy, for example, on the new owner, the purchaser of the business, so that should there be any kind of a life event, I guess I'll call it, they would be compensated. That would have the ability to pay off the note. So there's a number of things.
Okay, Don, there apparently the accounts receivable going with not going with the business is a hot topic of conversation. And one buyer wants to know if a normalized amount of accounts receivable should be included, and the other person wanted to know if you're in a stock sale, what happens to the accounts receivable. And then the third person wanted to know what happens if you're in middle market transactions.
Okay, I'll see if I can get each of those. So first of all, when you say a normalized amount, I don't know the answers to whether there's a normalized amount or whether there's a standard amount. I certainly see a significant number of deals for which accounts receivable simply are not included in the transaction. And we see some where they are. In terms of normalizing them, all the ones that I believe I'm familiar with, the accounts receivable are not normalized or adjusted. They can be, I suppose, for a little bit if you're in a business where there's bad debt is common. But typically you can calculate, in most businesses, you can calculate what the amount of the receivables are. You could negotiate to a percentage of that presumes late pay, no pay, or other issues, or discounting for future payments. But that's, I think that's going to be at the margin. By that I mean a relatively modest adjustment in most cases. With respect to stock sales, and by the way, that's going to be almost the same in middle market environments, because middle markets tend to be stock sales often more frequently. All of the things that we had on that slide that were part of the transaction, cash, accounts receivable and payable, lease, utility deposits, payroll, taxes payable, all of those actually go in a stock sale. And Suzanne will talk about that in more detail. But just to answer the question up front, those are not exclusions in a stock sale. We often lead with an asset sale and have a request to do a stock sale. And it can have significant impacts on the original price, which was based on an asset sale, and the deal structure. And it requires some very thorough professional analysis of what all those impacts will be in these various categories to have a deal come out as a stock sale that maybe began as an asset sale. There's quite a bit of work to align the two.
I'd also like to throw in there that remember we talked about creativity in deal structure. I think in the future, if financing becomes tighter, we are going to see taking the receivables with a business as part of the deal structure, and the price would be different. I've got another question here for you. Are there situations where client contracts would not be enforceable with a sale?
Well, it would depend on the contract. So there are contracts that have language such as if an appreciable portion of the business transfers to the new owner, terms like that make the contract transfer or not transfer. There are contracts that it has to be a stock sale where the entire entity is transferring for that contract. Now, I use the example of the cleaning company. I would doubt that would be important. But imagine if you had a government contract of some sort. That's more likely to require a stock sale. And so hopefully that answers the question. We can get pretty specific and answer the question for any specific business, but generically, it all depends on the contract, it depends on the sale, it depends on the type of business.
Would like to go in the lender rotation here and get Arvin back up. Arvin, how does putting your house up as collateral for an SBA guarantee work if you already have a mortgage on the house?
That's a good question. Typically, it kind of varies based on bank, but SBA's guidelines tend to be that if you have more than 25% equity in your primary residence, and sometimes even rental homes or other real estate, SBA will require a lien placed on said real estate. Now, lenders can have policies on top of that, individual lenders based on their own underwriting requirements. So that is something to kind of be aware of when you go into the process. And sometimes I've heard of people surprised kind of at the final table when a lien's thrown on their house. So it's something to clarify with your lender as you go through the process, as you get your approval, and as you kind of understand the requirements of the SBA loan.
Great.
Okay, one more question, which again, we've got somebody who's ahead of us. What happens with a business if a business has retained losses in its balance sheet?
Suzanne, why don't we handle that one when you get to your stock sale?
Yeah, I think when that's a good place for it.
Yeah.
You're thinking ahead of us, whoever wrote that.
Well, we always have a sharp audience, so I don't blame them for getting out in front. Okay, let's jump, whoever's doing slides, let's go to 32, and we'll go to business valuation again a little more. What we really indicate is that when you're trying to put a value on a business, and this is an early stage comment I'll make, and we'll talk about it throughout, but a business valuation is not about what a company is worth in the current owner's hands, even though that helps to set the baseline, what the current owner has done. Instead, it's about the company's transferable value, which is what the next slide is talking about. And that is, it's really going to be, what will this value be for the new buyer coming in? And that's why we've talked about things where we have to normalize certain values. We talked about the rent possibly being normalized. There can be employee changes that could normalize the business. There could be different things going on that are going to be important, that are going to define what the profitability is going forward. And that's really how the buyer is going to look at things. Okay, so we're going to get into valuation. And for those of you, some of you have probably done or looked at valuations in the past, others maybe less so. There are a number of ways. If you go out and Google valuation methods, you're going to find 7 or 8 or 9 or 10 different ways. And then some of them are going to have sprinkles on top, and some have chocolate chips. And there's going to be a lot of flavors of valuation. Common ones you'll see are discounted future cash flow. Tends to be used for larger companies. We're getting up into the mid-market space now, $50 million companies, or businesses that are growing, that you can project kind of a future view, and publicly traded companies. We see discounted future cash flow used with things like marijuana businesses, or in Boulder, in this area, there happens to be a very, very strong community of food products, natural food products, organic food products, really sprung up here. And you'll see that a lot of those businesses are getting valued not in that traditional model, but rather, you know, what's going on with this business? Where is it heading in the future? How can we leverage this brand into the future? And so they're going to be using those formulas. Another one is revenue multiples. You see this in certain businesses. They sell for 1 times revenue, 2 times revenue, 50% of revenue. There are some businesses where revenue multiples are common, but certainly it's not the most common way that most small businesses are valued. They are valued using the earnings multiple method, either EBITDA or SDE. That's the majority of business sales. We're going to talk about EBITDA so we understand it, because it's foundational to getting to SDE, sellers discretionary earnings, SDE. So EBITDA is an important foundational element of that. But as the next slide shows, earnings, where you calculate, in essence, the profitability of the business times a multiple, some number yields the value of a business. We'll go through that. That's very simple and high level. We're going to go through it. And the 2 most common ways we do that going forward are EBITDA, which is earnings before interest, taxes, depreciation, and amortization, which is professional management. If you have a business you're selling where there might be an owner, but it's truly run by a professional management group, it's large enough that the owner investor isn't actually the daily operations group for that business, then you're probably going to be looking at that business on an EBITDA model. If, however, you're smaller, you're owner operated, the owner is integral to the day-to-day operations of the business, and it's likely to be transferred to another owner who's going to be integral to the daily operations of the business, then you're using the seller's discretionary earnings, SDE model, times the multiple. And we'll go through both of those. But let's start first with EBITDA because it's foundational to both. EBITDA is earnings. If you pay taxes or if you look at the net income line on your P&L, that's your earnings, your net profit before, and I substitute sometimes the word before, I substitute the word plus to take the place of before, because in the calculations we do, we're typically doing an add back. Those interest, taxes, depreciation, and amortization have typically already been taken out on a P&L. So your net income line shows those being removed. So this is putting them back in. So earnings before or earnings plus, depending on the way you're looking at that particular financial document. And I'll just briefly talk about depreciation and amortization there. Depreciation is a non-cash expense. If you bought a big piece of equipment, you've put it on your balance sheet and you're depreciating it on your P&L. Let's say you spent $200,000 for a piece of equipment that you're going to depreciate over 5 years. On your P&L, you have a $40,000 expense line for depreciation, but you didn't really spend those $40,000. Oops, did I do that calculation right? Anyway, whatever those dollars are, it's a non-cash expense. So you want to add it back to your real profits. Amortization works exactly the same as depreciation, but it's for intangible assets. So an example of an intangible expense might be you put on your balance sheet the fact that you purchased a business and you're amortizing that over a number of years. The amount you amortize in any given year is an intangible expense that's showing up non-cash. What's the goal? The goal of calculating EBITDA is to understand your operating profitability. That's what you're really going after, and that's what you're trying to understand. So that's what EBITDA is. SDE, seller's discretionary earnings, takes EBITDA as your foundational element, and it adds back additional monies to that, which include owner's salary and benefits and payroll taxes, plus discretionary expenses. So what are discretionary expenses? Well, if person A owns a company, they might choose to spend their money this way. And person B might choose to spend their money this way. By way of example, person A likes to give lots and lots of donations to the American Heart Association. And so they've taken some of their profits and used those as an expense, discretionary choice on their part. Person B doesn't give donations, but pays their kids' college tuition. Those are discretionary choices. They reduce profitability, get their net income lower, and all business owners love for their net income line to be as low as possible because that is their taxes. But it is really important to understand what that seller has done so you can calculate the amount of profit that is really available. There are also some normalized expenses. We used rent as an example earlier on. If under a new ownership scenario, a buyer of the business is going to have to pay $2,000 more in rent every month than the previous owner did, it's going to reduce their profitability by that amount. You know that. You normalize seller's discretionary earnings by dinging it, taking out $2,000 worth of profitability that reflect what the new owner is going to be facing. We talked about transferable value from seller to the new owner. There's a perfect example. And then a business might also have had some one-time expenses. Let's say in 2018, you incurred a lawsuit and you hired an attorney and got it all cleaned up, and you had to pay the attorney $6,000, and you also had a penalty of some sort, another $10,000. That's a one-time expense. It's not a normal course of business expense, not like having an attorney just on a retainer to do general business stuff. And so you can add back a one-time expense. You might also have had a particular amount of damage, vandalism to your property that required some repair. A one-time expense, it hurt your profitability that year, but it's not ongoing. And so those can be added back. And when you put all that in a bucket, you're going to have the seller's discretionary earnings, which is the cash flow. And if you want to describe that the way we do, we say seller's discretionary earnings, SDE, is all of the money and financial benefits that one working owner can derive from the business, assuming no debt. And we're going to be using that in this workshop as we move through. And we'll talk about what some of these things are. But notice that one working owner, that's another normalized expense from the previous slide, because if there's two working owners, you're going to be perhaps replacing one of those with an employee. That second working owner might be a spouse who wasn't getting paid, in which case you're going to get additional expense, or it might be a partner who is getting a larger than market rate owner salary, in which case you would have more profitability replacing them with that employee. But you need to know which it's going to be, and you need to calculate for those. What are we trying to do?
There's a question directly related to that.
Okay, great.
If a buyer will not manage the business and a new manager is required, then should you still add back the owner's salary, or do you normalize that expense?
Both. You would add back the owner's salary because it wasn't in fact paid to the owner, but then you would normalize for what the situation will be. If the owner was paying themselves nothing, you'll be adding back very little. The new owner, might need to see something different. So it really does require, and calculating shifts in employee base can be very important. I recently was involved in the transaction of a restaurant that had 4 family member owners all making great salaries, because it was a very profitable restaurant. And so it was going to come in, it was going to be a single owner, would continue to make a great salary, but would ultimately be replacing 3 of those owners with employees over time who would be making less. So there would be increased profitability for the new owner. And that can be reflected in the value calculation. We certainly reflected that in the value calculation of the business. Okay. So we're going for apples to apples. And I like this slide because one of the things that we can do with this is talk about buyer behavior for a quick second. And that is, when a buyer walks into our office as brokers, they don't necessarily say, I want that business. They walk in and say, I'm looking for a business that, and they might say, generates $150,000 a year in SDE, is manufacturing oriented, and doesn't have a huge employee base. And this is your opportunity to say, well, there are 4 businesses, or even if the person is not necessarily in a brokerage, if they're just out looking on their own, there might be 4 businesses that they're looking at that meet their criteria. By putting everything down into an SDE calculation that's done reasonably similar fashion, you get an apples to apples comparison between businesses. That's how buyers can tell whether their investment is better placed in this business or that business, not just whether they happen to like that industry. So super important. Okay. So the defining the earnings is that common method to compare businesses, their profitability. Business financials are recast. Recasting is another word for those adjustments we made, where we took EBITDA and added back the owner's salary and discretionary expenses, and we normalized things. That's called recasting the financials. It's calculated uniquely for each business because, number 1, all businesses are different. And 2, even if you had 2 identical businesses, those owners would run them differently. They would have experienced different things that they needed to account for. And so it's important to recognize that. And also, when you're defining those earnings, you want to take the legal entity, the accounting procedures, and other differences into account. A business might be a sole proprietorship. It could be a single party LLC, multiple party LLC. It could be an S Corp, it could be a C Corp. That's where the previous financials were based on, how those businesses were run. But maybe the new buyer is for sure going to make that LLC into an S Corp. We're going to make that S Corp into an LLC. Those are the kinds of changes that need to be taken into account. So how do you get this number? We talked about it's the earnings times a multiple. How in the world do you figure out the actual earnings? What do you use to do it? And the starting point are the relevant financials. So profit and loss statements are a wonderful starting point. That gives you, and Suzanne, you heard Suzanne mentioned early on, the importance of good books. she would say, she would stand up in front and jump up and down and say, good books, good books, good books, good books. P&L statements are the roadmap for a buyer. They're the place that they're going to be able to analyze the business profitability and decide whether what's being represented is in fact true, or at least it's one of the documents. So well-kept books allow the buyer to see the business. And trust me, if the buyer cannot clearly understand the financials, they're not going to jump off the diving board and take the risk of jumping into the pool. So they're going to be very cautious. So profit and loss statements, business tax returns. Business tax returns have some great information on them that's useful. They also corroborate the P&L and the balance sheets. By having those business tax returns, you can see, is all of this information holding water? Is it holding together as I look at more and more pieces, or is it falling apart? Balance sheets. Balance sheets are a great place to see the health of the business. You can see whether cash is being pushed into the business to keep it afloat. You can see whether the sellers have accumulated through their profits a significant amount of cash. It's not uncommon at all to see longtime owners sitting on vastly more cash than is necessary to run the business. Evidence of the fact that the business has been paying off. It's been profitable. Monthly sales. So a P&L, an annual P&L, an annual business tax return, and a balance sheet as of a given day, they're going to show you what the story looks like annual. But monthly sales are going to show you lots of things. And we love to see 5 years or more of monthly sales because they show you all the trends. They show you if a business is seasonal. Is there a huge Christmas spike? Is the money made in the summer? Is this a back to school type product that's being sold? And so it would go with the school year. Monthly sales will tell you that. That is a general trend for the business. It's going to help you understand your cash flow, when your cash flow needs are greatest, when you might be doing your ordering of products, things like that. There's another piece that monthly sales show, and that is they show if something precipitous has happened. We recently looked at a business that, the annual sales year to year weren't too different. They dropped off a little bit. We see some up and down. But when we looked at the monthly sales, we actually saw that there was a very strong growth trend in the beginning of the year, and then a massive decline at the back end of the year. The year added up to what the previous year had been, or close enough to be comfortable with it. But what happened was, this happened to be a styling salon, and what happened was a number of the people had walked out and left, moved on, and now there was no additional revenue coming in, and there was going to need to be a significant regrouping to get that styling business back on. It was a spa, back on track. So keeping in mind that looking at those more granular monthly sales can give you evidence of what's really going on in the business. And we talk about accrual-based accounting. If you run a restaurant, it doesn't make a big difference if you do accrual or cash-based accounting, because every single night you're depositing all of your receipts and your expenses are all very short-term. But if you run any kind of a business that has a lag between the expenses you incur and when you can recognize your revenue, accrual-based accounting helps normalize all of that in a way that helps everyone, whether it's the lenders or the buyers or the brokers or whoever's involved, to understand how money flows through the organization. So accrual-based accounting is an important step. So that is the starting point. You collect those items and you're able to get it. Oh, by the way, I always forget to mention unreported income. In today's economy, where credit cards are much more common, there's far less unreported income than there used to be. Still happens in bars and restaurants and other things, but it doesn't happen at most typical retail outlets or other businesses. But if you, as an owner, are pocketing cash and not reporting that, it's not something that you're going to want to reveal in the sales process. Hey, buyer, guess what? I defrauded the IRS of $50,000 this year. You can too. And it's just not something that you can use. And by the way, economically, it's not a very valuable program to run if you think of it this way. If you think that you made $1 of profits and that profit is going to get multiplied by something, I'll jump ahead and I'll grab a number 2.5. That means that $1 of profits is going to be worth $2.50 to you when you sell your business. What's it worth to avoid taxes? I'll pick a number depending on your tax rate, 30 cents. So you're going down the road of saving 30 cents to lose $2.50. So if you're a seller and you're thinking, how can I best prepare for going down the road and capturing maximum value in my business? If you have not been reporting cash income, it's time to start reporting cash income. It will pay off for you. Okay. Owner salary. What's included in owner salary that you're going to add back? W-2 wages or guaranteed payments. A lot of owners take distributions out of the bank account. Perfectly fine, perfectly legal to do, but it is not added back. And the reason it is not added back is it was not deducted on the P&L. That money already flowed to the net income profitability line. That's just how you're using those profits. That's not anything that would get added back. But W-2 wages and guaranteed payments do show up on the P&L, and therefore they are added back. There's been a question about owners and adjustments. Yes, multiple owners. The adjustments can be both positive or negative depending on what you need to adjust for. And so that's something that gets looked at. And we can, I think, is there in the example, there might even be an example of adjusting for owners, but we can talk about that. And then the next category is discretionary expenses. Again, using the term, these are add backs. You started with EBITDA, and then you added back owner's salary, and you're adding back other discretionary expenses. But there's 4 rules, and these rules have to apply for them to be a legitimate add back. 1, they have to benefit the owner, not the business. If they benefit the business, they're an expense. But if they benefit the owner, such as you spent money to your wife's Porsche, paid the payments on that, and she doesn't work in the business, that's a benefit to the owner, not to the business. Not a benefit to business or employees. People ask us all the time, is the Friday evening pizza and beer gathering for my employees a discretionary expense? No, that is a benefit to the business and the employees. They are used to having that happen. The last thing you want as a new owner is to come in and cancel the pizza and beer party. Talk about killing morale on your first day. So that is definitely important. Okay. The next thing is that it be paid for by the business. It has to be an expense, and that expense has to show up on the P&L line. So it has to be paid for by the business, and it has to be expensed on the tax returns and financial statements. So, you know, people have tried to do a lot of things. They try to include a significant number of unusual things in discretionary earnings. Even we had one try and add their airline miles as an add back to SDE. And airline miles are a wonderful thing to get, but they're not an add back to SDE. Okay, let's see here. We are on discretionary expenses. Okay, so we talked about these. What does get included? Health, life, disability insurance are all add backs. Those are, we talked about things that economically benefit the owner, that are the choice of the owner as to whether or not to spend the business's proceeds on. So health, life, disability insurance, retirement plans, IRA, 401k, SEP, those are all elements that you would add back, but they have to be for the owner. They have to be for the owner. You'll notice we drew a line across this slide, and the reason we drew a line is because everything above the line is something that our great lenders like Renee, who we'll ask to talk to this in a second, will look at and say, of course, those belong in SDE calculations. You get down below the line, and these are in fact discretionary choices. Travel and entertainment, you take a trip to New York or to Las Vegas, charitable contributions, personal things you get like, oh, the cars are paid for, boats, tuition, put a new patio on your home. Renee, can you talk a little bit about how an SBA lender would look at these? And one of the reasons I bring this up is when you're trying to sell a business and get maximum value for it, you have to sell these sellers' discretionary expenses 2 times. You have to sell them once to the buyer, so that the buyer feels confident, they understand how much money is there for them. And you have to sell it once to the lender who's going to finance it. Renee, how do you look at these things?
Absolutely. So when I talk to some buyers, we always talk about, okay, let's take a look at all the expenses, and we're not going to add back car payments or children's tuition or vacations or anything like that. However, their lenders will add back the health, life, disability insurance plans, retirement, so IRA, 401ks, and SEP. Those are absolutely considered add backs. The one-time expenses, if there's a one-time extraordinary legal event, if there was a lawsuit or something like that, certainly can add that back. Possibly moving, improvements to the property, inventory adjustments, new lines, things of that nature, but it's all case by case. And if a lender is going to consider a one-time add back, there absolutely would need to be documentation. So if the seller can prove via receipts and canceled checks, then the lender can consider it.
Great. Thank you. Thank you on that. So we're gonna go to a break in a second. I think my remaining slides will go very quickly. They aren't as soft. So if I could, why don't I just hit these last couple of slides and then we'll take the break. So first one, normalized expenses. That was another list. Reflect the new owner's reality. We talked about rent. We've talked about employment. There may be other things, for example, with suppliers. You may not be able to get the same terms as was previously gotten through another supplier. You may not want to stock as much inventory, so you may get smaller discounts because you're not doing big purchases. So there's a number of things that reflect a new owner's reality, and those will be normalized. Now, sometimes those aren't normalized in the original value calculation, but they become part of the buyer's calculation as they see themselves moving into the business. And so therefore, they're going to want to reflect that, and their offer may reflect those changes. So all of those kinds of things are ways that expenses get normalized. We can move on. One-time expenses, as Renee, here's just the list: inventory adjustments, equipment purchases that are not on depreciated schedules, new product line R&D, sale of a business asset. We see this frequently where there is actually income shown to the business for selling an asset, but that's not actual income that a new owner would have. That asset has been sold off. So that is actually deducted from profitability. So sometimes you have additions and sometimes you have subtractions, but you're going to adjust that net income for these one-time expenses that you did incur. Okay? So we've put all those things in a bucket and we now have earnings. We have calculated what is the economic value that flows to a single owner without debt for owning this business. And that's going to be multiplied by something. What is going to be multiplied by is the multiple. And the multiple is going to take into account what's the riskiness of this business? What's the likelihood of future income? What's the replicability of income? What are my options to invest these same dollars and do something else? Do I have riskier or less risky investments available to me? So the multiple is going to always be looking at those. All right. And some examples of investments, it is very unlikely that the pet rock is coming back. Whoever invested in it the very first time did great. Probably made millions and millions and millions. But I doubt you'll be able to reintroduce the pet rock. It's not an investment that I'd recommend. The multiple on that might be 0, even though the earnings were good. Let's look at the next option here. What's the ability to replicate a Michelangelo painting on the Sistine Chapel? Probably not likely. That's not a business where you're going to have that replicability. So again, that multiple is going to be 0. Okay? Things do influence the multiple, however. There are things that are going to influence it going up and things going down. Industry desirability. Some industries are simply more attractive than others. We used to always say owning a bike store in Boulder, Colorado is an attractive proposition, whereas owning a septic pumping business out in Frederick, Colorado may not be. But you know what? Everybody can look at that and decide what works for them, but some are just more desirable. Sales profile concentration. If somebody says, I am doing great, but 90% of their business is with one customer, high risk proposition. How do you know that you're going to be able to maintain that? So how is that profile designed? Contracts where appropriate. We talked about contracts a little bit earlier. Anytime you can have contracts that demonstrate less risk going forward because the customers are under contract is going to be advantageous. Stickiness of your product and customer base. If you can demonstrate that you have something that it's difficult for customers to leave and you can retain them, that helps reduce the risk of the buyer coming in. Recurring revenue versus project revenue. A business that has subscriptions, has memberships, has recurring revenue type rather than selling one-off products on a regular basis, I think is going to make a difference. Competition and barriers to entry. What makes it hard for someone to come in and try to steal your customers? Management, staff, labor base. If you're able to demonstrate that you have a team that has been working and is consistent and knows the business and how it works, that's going to be helpful to you in showing that there's less risk in the transition because their team's going to be able to carry the business forward. Facility capacity technology. Are you doing $5 million worth of business out of a facility that should really only allow you to do 4 million and you're shoehorned in and there's no growth opportunity in that space? Or are you doing 5 million of business out of one that can do 7 million and therefore that facility can accommodate without moving? And the same thing for your equipment. Are you getting the maximum out of your equipment and it's about to all break? Or do you have enough capacity there to move forward? These are all things that are going to influence the value of a business. Are you in the right spot with a location? Do you have a favorable lease? Growth outlook, scalability, economy, what lies ahead? You know, people in the construction business, it doesn't matter if it's booming or it's soft. People always wonder what's around the corner in the construction industry. Now, that doesn't mean you shouldn't go into the construction business. People are very successful. There's great margins and great profits to be made. But for some people, understanding what the growth potential is in that industry is important. And it's very cyclical. So you got to be in a position to manage that. And then ultimately, size matters. And that is that larger businesses are going to get a larger multiple. So these are all general influencers. Can I put a specific number on each one as to what they'll do? No. But I can say that if you have more positive influencers, it's going to increase the value of your business. So what are those multipliers? Typically 1x to 4x times SDE. That's the range. We see businesses at 1, we see them at 4. Bigger, better businesses, the biggest, best businesses can be up to 4. The smaller, less successful businesses can be down to 1, absolutely. And so that's always going to apply. Size matters. 2.2 is the national average. What's amazing about that is it is not a volatile number. That's a number that has existed for years within a range of just 1/10 or 2/10 maximum movement. It just parks there. And so we know that it's very representative in all economic times and over time. However, the rules will change for larger businesses. We've talked about mid-market businesses. We've talked about strategic buyers. We can get into that maybe a little bit later in some Q&A. Strategic buyers are a mixed blessing. They don't always mean higher price, even though that's what a seller would like to think. And so it's important to look at that on a case-by-case basis. Okay? Back to Suzanne's slide. If you look over on the far right, small business, 25 to 100% ROI, much better returns than putting your money into other categories. However, as it goes up, the risk goes up. People need to understand when you're buying a business, you are buying into the risk that goes with that business. Who would have thought COVID-19? So that's just reinforcing that buying a business is a great idea. It's great ROI, but it comes with risk. And this looks a little bit trying to explain those multiples. If you look at the bottom line, you'll see that 2.2 average. But as it moves through larger to smaller on median sale price and median SDE and median revenue, all three of those, you see this is calculated from real sales, thousands of transactions over a period of time. It's not a volatile number. It's pretty consistent. And you can see how that plays out from smaller to larger. So really important to keep that in mind. We always say you can't be smarter than the market. Businesses are going to sell for what the market believes they should sell for, not just what the seller wants them to sell for. And so that's always very important to keep in mind. I'm done with my slides. Happy to take questions.
There is a question, Don. it says there are different multiples that are applicable to different industries. Can you speak to why?
Yes, absolutely. It really goes back, I think, to a great extent to risk and how the money is made. A restaurant, especially one that doesn't have a strong long-term history of large profits, is a very risky venture. And so as a general rule, it's not going to get a high multiple. Whereas somebody that has a product that is well recognized in the market and is successful and has been selling itself in that market for 10 or 15 or 20 years with no sign of industry shift or competitive shift that's going to cause it, is going to get a higher multiple. And so that's the nature of that. I'd like to call maybe our third banker back, because bankers look at so many businesses and see these multiples all the time. Maybe you could provide a little insight on how you see multiples from a lender perspective.
Is that for Vic?
Yes, for Vic.
Yeah. You know, we're going to just take the most conservative approach, and you know, the common sense rule does apply. If it's riskier, you know, the multiple should be less. So I think that's a very vague way to answer it, but I don't think there's any real rocket science as to how you've come up with it. But it needs to be able to justify the valuation and not be a stretch.
Right. Thank you, Vic. And I think one of the things that we're able to do as brokers, we have access to databases. And so those databases give us comparable sales in many, many, many industries. So we're able to see not only the averages, but the businesses that sit as the outliers within that. And so we can really see industry by industry what is expected with that. And so that'll be helpful. I think there's some Pratt Stats is one of them. Biz Buy Sell is another one. I'm not sure all of these are publicly available, but we can talk about the actual resources. Maybe Paul, you can share some information, or Suzanne, about things that might be publicly available.
We have some resources at the back in the exhibits, Don.
Okay, great.
There's also another question. Someone would like guidance on multiples for the EBITDA range of 1 to 1.5 million. And it
So EBITDA, yeah, I mean, just obviously it's going to be general range, because not knowing anything more, I'm assuming that's a $1 to $1.5 million sale, or $1 to $1.5 million in EBITDA. I'm not sure. Let's take it as if it's EBITDA. EBITDA tends to be in the 3 to 3.5 at the bottom end, to 5, 6 even at the top end. But it's very hard for me to be specific with respect to any number, because not knowing the business, the industry, and anything else.
If that's wait, oh boy, is there a mathematical procedure to know which multiple to apply, or is it subject to negotiation between the parties? By mathematical procedure, I mean equation or model or regression to apply to the data available.
Very good question. So let me describe a couple of things that are going to influence the multiple. So number one is comparable sales. What has the market said previously? Number two is going to be risk. What's the perceived risk and the transferable value to a new owner of this business? Three is going to be lender's approach to looking at that business? Will a lender step up to the plate for a price that is based on a high multiple and make that amount of lending available for that business with what they know? All of those are going to be moderating influences and definers on how a multiple is chosen.
We've got another question here. So just to summarize, usually the sales price of a business is SD or EBITDA times the multiple plus the asset value. Did I understand that properly?
No, but close. No, when you say the asset value, I think you're talking about the value of the tangible and intangible assets that are included in the sale. And that goes back to the comment I made earlier. Assets exist to generate profits. Assets are typically included in the sale. And because they are considered essential components for being able to generate those profits to begin with. For example, you can't have a machine shop without the machine tools. By having the machine tools, you're able to generate a certain amount of profits. The profits then define the value of the business, not the value of the machine tools.
Okay, boy, we could go on with this topic all day long. And what the take home, I think, is that valuation is unique to every business. And so when you're buying a business, you need to get professional help. And your SBA lenders are going to require a third-party outside valuation. But I think now is the time to take a 5-minute break. Did we answer all the questions? Hey, Amira, could you pause the recording? Or we're there. Oh, sorry. Okay. So it is 3:15. Be back at 3:20, everybody.
Loans approved for 247,543 billion. And at the end, so far today, I know that we're up to 300. So just really proud of the industry as a whole.
Okay.
Wow.
It's 3:20. Thanks for those of you that were listening. You were getting some pretty good insights from the lenders, and that's one of the reasons we're really excited to get into the next part of the show. At this time, I'm going to introduce Dave Harris and let you say a little bit about yourself and take it from here, Dave.
Great. Hi, everybody. So my background is unlike Don with his 49 years. I've been here 12 years. I'm a refugees, buying and selling businesses. I actually sold I sold a small business I had here in Colorado with, with this team. In fact, Don was the agent. So let me get to the kind of the meat of it. What we're going to do is we're going to take what Don was talking about in his last section and actually work through a recasting example. We're going to develop the SDE and get to that apples to apples combination, a comparison. So not to beat a dead horse too much, but the seller's discretionary earnings is kind of the key nugget that we need to do the valuations. That's EBITDA, as Don said, plus the owner's normalized expenses we were chatting about here not too long ago, and the one-time expenses. That all ends up being the SDE cash flow. And a way to think about that is it's all the money, financial benefits that a single owner gets from the business without interest. So where we're going to go in this section, we're going to show you some pretty dense images. And if you can go to exhibits, the different exhibits that will be listed, you can see the whole thing much easier than you can obviously on the screen. Then as we talk through and build the SDE, we're gonna zoom in on the different, particularly the yellow spot, so you can really see it. But if you printed the exhibits, you're gonna be in great shape to get a good idea of it. So what this is this business is an S corporation that we're gonna walk through. We're gonna assume this. So their tax return is an 1120S. Many of you probably have this structure. Some have LLCs. There are different tax forms for those, for partnerships, for C corporations. So in this example, again, we're going to be looking at an S corporation. So if we can go to the next slide, there we go. So here's, if I can, you got to move some of the boxes around. So, so what we're going to do here is you look at this business that's a $2.5 million business in sales with gross margins of $1.2 million, net income of $125,000. We're going to show you how that generates $400,000 in SDE. So in this whole process, we're going to assume one owner. So we're not going to make the multiple owner adjustment that was discussed a little while ago. So the officer, the president, makes $150,000. The business is paying $30,000 in interest. We're depreciating at a rate of $25,000 a year. And if you remember, that's not real cash. That's the government lets you basically expense your assets over a little while, over whatever the asset life is. The pension we're going to assume is just for the benefit of the owner. So $25,000 in profit sharing, and then $190,000 in other deductions, which we'll walk through in a second. And as we mentioned before, the ordinary business income on the tax return is $125,000. Okay, so let's go to the other deductions. There we go. Again, this is one of those forms where we're gonna zone in a little bit, but it's in Exhibit 2. So the other deductions. So if we can go to the next slide, please. There we go. And so you can actually see this. So looking at the yellow, so amortization is a little bit funky, and we did talk about this. This is in essence, you get to write off the intangible assets. And this could be a franchise fee, which is pretty normal, or if you bought a company, your carpet cleaning company, and you bought your competitor, you get to write off the goodwill. That's amortization. So that gets added back in. Automobile and truck expense, what this is here, this is the owner's writing off personal automobile expenses. This is not anything he's used for business. And then in this business, they had they had to go hire a lawyer to deal with an employee. So it was a one-time expense. So we get to add that back in. And then to finish up the other deductions on the next slide. There we go. So what we've got in here, the rest of the deductions is $10,000 in travel. And, we've said it several times, but the travel and entertainment, auto expenses for personal, those are things that are going to be a challenge. And aren't quite the same quality of SDE as pensions and things like that. So other deductions, $190,000. Okay, and so what we've done here is develop, this is a worksheet for looking at the SDE earnings worksheet to kind of work our way down. And again, this is an Exhibit 3. Now we go to the smaller one. here. So net profit of $125,000 for the business. We get to add back owner's salary of $150,000, the interest payments of $30,000, the depreciation of $25,000, and the amortization of $10,000. And then we get to the discretionary expenses. The very solid one that the banks are happy for someone to be doing is retirement plans, IRAs, SEPs, and things like that. Automobile, truck, and travel expenses are less interesting, are less solid. So that the automobile expense of $15K, the retirement of $25,000, the travel and entertainment of $10,000. Then you add the one-time legal expense of $10,000, and that's to $275,000. You take the $275,000, add that to the net profit of $125,000, and gives you the seller's discretionary earnings of $400,000. So I'm just going to go ahead and answer this question that came in. She asked, why interest? Because in the apples to apples comparison, it's assumed that the new owner is going to have no interest. And the reason you assume that is because you don't know what the new owner is going to, what his financial resources are, or what he can borrow money at. And so that's added back in. Okay, so we looked at this with Don. Here's a real example. So we take the STE earnings of $400,000 times the multiple of 2.5, and we had a long discussion about what influences the multiple. So we chose it to make the math easier. But if you remember that the national average is like 2.2 average. So our business value is $1 million. And again, just to emphasize, we don't include working capital as an asset sale. So that's excluded from this as we move forward. So you can see where the numbers that Don was talking about come from the tax returns, and why you need to have those tax returns for the lenders. Okay, and if we can move on. So are there other questions?
Providing bridge loans, that's an embarrassment.
Okay. Okay, that's more of somebody, if you ever want it, they're working with private lenders providing bridge loans with hard assets. But we actually did have a question. Could the participants get the contact information of the lenders? And yes, Amira, hopefully we can send that out to everybody. We'll get those to you. Thank them for being part of this. So let's move on to the part that's actually quite relevant to them.
Yeah, absolutely. So we talked about how we develop the value of the business, kind of put some numbers to the discussion that Don had a little while ago. Now let's talk about financing it. And it's important to know if you're a buyer or a seller, because you're going to be on both sides. Back to that, is it a 6 or a 9? Everybody has to be in sync with putting the deal together. Excuse me. So typically in a typical deal, you're get all three of these: cash, bank financing, and seller financing are going to be part of the deal. At least, the vast majority have 2 of the 3. So as we move forward, we're gonna develop these in a little bit more.
Hey,
okay.
Hey Dave, we have a question that maybe should be answered now.
Okay.
Relevant to the last section. We've got a buyer who's negotiating with the seller, and the seller is holding on very hard to their discretionary add backs. And the buyer wants to know how to reconcile that.
Well, So one of the things that one of the benefits of having a lender involved is he can be kind of the third party to say, hey, you know, to both parties, these are solid, right? It's the retirement, it's, you know, the owner's salary and things like that. And also to say, you know, the SBA is not going to accept your vacation homes and things like that. Sometimes to get a deal done, it's nice to have a third party kind of being the bad guy. If you have a broker involved, he can explain the realities of it too. You know, if the buyer can't get money from a bank, then you're not going to get the deal anyways. Okay, so I'm going to move to cash. So there's, you know, the most obvious way to pay for something is cash. You know, personal bank accounts. You can, you know, liquidate stocks and mutual funds. Okay, something that you could also consider if you don't want to sell the stocks or mutual funds, you can actually borrow against the portfolio itself. So a bank will give you a percentage. If your stock's worth $1 million, they'll give you $400,000 or $500,000. You can take a loan against that, and that's pretty solid. So the loan interest rates aren't huge on those. You can sell or borrow against investment real estate. Okay, the home equity loan is the fastest to get. It's very, you know, it's typically very inexpensive to get a HELOC against your home equity. So that's a good way to think about moving forward. You can obviously liquidate IRAs and retirement funds. Something that's come up here over the last few years and gaining popularity is something called it's rollovers as business startups. And ROBS is sort of this unfortunate acronym for that. But what it does is the government has said you can take money out of your IRAs they're in stocks and things like that, and basically invest in you, give you money to buy a new business. And it's not taking it out of the IRA, but it's a fairly complicated process. You have to have a third party who will help take the money legitimately out of your IRA and then reinvest it in your business purchase. But it's basically, you know, the government says, okay, you can invest in yourself as much as you can invest in IBM or anybody else's stock for your retirement. And then obviously you can get money from family and friends. One of the things to think about there is, are these family and friends are they going to have equity? And so if they're going to have more than 20% equity, you'll see as we move forward, the banks are going to require some things from them. Okay, so can we move on from there? So, you know, bank financing, right? We've got our three bankers with us. So there's two types of approaches. From a commercial lending standpoint, it's not used that often to buy a business, and that's these loans are based on assets as collateral. So in the business, if they have $1 million worth of equipment, a bank sometimes will, based on an appraisal value, give you 40% of that ish moving forward. Goodwill is not financed at all. So the more typical approach is through a loan that's cash flow based lending, and that's guaranteed by the SBA, the Small Business Administration. And so this is, a government agency that's put together specifically to let people buy, help people buy small businesses. It's based on, again, cash flow. So there's two programs that are available. One is for a business-only loan, 7A. And so you can finance a business-only loan for up to 10 years. You can go buy commercial real estate. on the 504 program, and that lets you can go distribute that, amortize that over 20, 25 years. And if you're buying a business with real estate, it's really part of the 7A program, but it results in a blended interest rates and terms. So you can typically get that out to 20 years. So as you look at going the SBA front way, one of the things that we would advise you to do is go to a lender who's a preferred lender. That means the SBA has said, okay, we're going to delegate some of the paperwork and approvals down to you because you're good people and you follow our rules, and that makes things go a lot faster. Anybody can petition the SBA for a loan, but if they're not a preferred lender, then everything has to go back to the SBA, which slows things down a lot. And I'm sure that our lenders would agree to that. So if you could advance us. There we go. So there's kind of a long list of things. This is the requirements that the SBA has for making a loan. And what you'll see is that as you get into working with different lenders, they'll have, they may ask for a little bit more than what the SBA has, because they have their internal underwriting. But every SBA lender has to meet these minimum requirements. So what the SBA cares about, pretty logical stuff, is, so tell us about the business, give us some history, and they want to know that it's a good investment. So in the process, there'll be an independent valuation that'll be required. And this is from somebody who's certified, and there are a number of large concerns that go through that. And they'll go through the financials, a lot of that, as well as the history. So they'll always require 2 years minimum business tax returns. In addition, they'll ask for the profit and loss statements year to date, so you know how well it's doing this year. All pretty logical stuff. Now, here's something to really be aware of, and this is particularly important today. There's actually more emphasis on it. So the cash flow, or the STE, has to support loan repayment and the buyer's lifestyle expenses. So in this process, they'll look carefully, and what you'll see is that two buyers who have different lifestyle expenses will get different money. So if you think about it, one person who has another spouse who's working, paying all the day-to-day expenses, they have their home paid off, and so they have lifestyle expenses are pretty well covered, versus a buyer who has 2 or 3 kids in college, spouse doesn't have a job, all the expenses have to be paid by this business. They'll get different proposals from the SBA lending process. So that's one thing to think about. And as we move forward here, there's more emphasis on making sure the cash flow can really cover the lifestyle expenses, and there's some cushion going forward. So debt coverage ratio of 1.5 times, basically making sure you can pay. And there's some more cushion to make the debt payments. We've emphasized 1,000,000 times, some of the add backs may not qualify. So just prepare yourself. The more solid you get, the more money you're going to be able to convince the banks to loan against your business. Again, something that's happening quite a bit now, renewed emphasis on, is the buyer experience and qualifications. How can the buyer's got to show that he or she has high quality experience to be able to run this plumbing business, to be able to run this construction business. And that's getting tighter and tighter as we move into 2019. So it's important. Somebody who's comes from a desk job is going to have a hard time explaining why they could, run a plumbing business. Obvious, one of the obvious things is, great buyer credit. That's very important. And here's where I mentioned, so there's a personal guarantee that came up. We were talking to Arvid a little while ago, or actually Vic. But there's going to be personal guarantee required of anybody with more than 20% ownership interest in the bank, or I'm sorry, in the business. So that's something to think about as you're getting money from family and friends. The SBA is going to push to collateralize your home. If you've got more than 20% equity in the house, you're going to have a hard time convincing them not to collateralize the home. So this, lessons learned here is you got to make sure that both partners are signed up to have the house collateralized. We had a perfect buyer, great experience. He had plenty of money. Actually, he was using Hobbs to pay for it, and his significant other refused to collateralize the home, even though the home was not worth all that much. But she was very uncomfortable collateralizing it. So the deal went to heck.
Hey, Dave, I think a lender might have a little input there, one of our lenders.
Okay. Go ahead. No, I was just teasing. So Vic, how about you?
Well, give me the high level of that question again.
So what Suzanne was talking about is the SBA requirements, the collateralizing the home. What's your, do you have any other comments to make?
Yeah, we're going to take the home. It's very difficult not to take the home. It'd have to be, really there's no reason we wouldn't take that home. I know there's that LTV requirement that you need to have, but we're taking the home, and a lot of people push back against that, but there's not much you can do on that one.
Hey, Renee has a comment she'd like to throw in on that.
Hi, everyone. I just wanted to let everybody know that the SBA requirement in the regulations that all banks adhere to, the threshold is if the loan is not fully secured with business assets, then to the extent available, they would pledge their home. The home does, the residence or rental real estate or any other commercial real estate that might be owned, there would have to be a 25% equity threshold. And there are thousands of SBA lenders across the country. What I tell everybody is if you have, 50% equity in your home, it's definitely going to be pledged. But if you have 22% available, there are some lenders that are going to say absolutely they're taking it, and there are other lenders that will say no, we're only going to take it if it has 25% or more. So definitely I recommend that everybody talk to many lenders and ask those questions up front. And if, like I said, there's a lot of choice out there. So, there is absolutely a home for everybody in the lending community, and definitely talk to multiple lenders.
And what I was trying to get to is that some lenders will let you take out a HELOC and get it below that. But from what I understand, then they're going to count the payments on that against your cash flow as well.
Yes, that's correct, Suzanne. So I work with a lot of clients where they have a first lien with a bank, and then they have a second lien for a home equity line of credit. Even if they have $0 advanced on that line of credit, the lenders are going to evaluate it as if all of the funds have been depleted, because we want to make sure that we factor in the correct first mortgage payment and second mortgage payment. But then that might make you to where the house can't support a third lien. So sometimes it's to everybody's advantage.
Yeah, I think that we've been hit a lot of different things. I think one of, Renee, key bit of advice is to shop around and talk to a number of vendors, a number of lenders, okay? Because there are different pressure points. And to the earliest point that Suzanne made is there's a lot of creativity in getting a deal done. And that's where having professionals, having, different lenders, well, if you do this, you can do this. So there are different pressure points. It's not just, all A, B, C, D, as we walk through these things. So thank you. So again, this is back to our format of kind of showing you a big screen, and then we'll pro it down here a little bit more. So what we're going to do is we're going to talk through a typical loan structure, SBA loan structure. And one of the things I will tell you is we were debating this yesterday is how much do we update it for some of the things that are temporarily changing with SBA right now. We said, we're going to keep what we had a month ago because that's sort of more typical. But there are some interesting programs that we'll chat about actually at the end, where SBA and the Fed is being nice to people to encourage these transitions. Okay, so let's go. So our business price was $1 million. What we're assuming in here is that the working capital is 10%, and the SBA wants to make sure that in this process that there's working capital to make this business work, because that's a place not to skimp on it. So in this case, we're going to do 10%. Math makes math pretty easy. And then we've got an SBA fee, an SBA packaging fee. These are things that are right now being waived. And I don't know how long it's going to be, but if you were buying a business right now, it's going to be a very, very attractive time to deal with lenders. The SBA is being very gentle as we move forward. Then there'll be loan closing costs. So if you look at it, a month ago the SBA fee was 2% to close. Then the loan fee of $3,500 is an estimate. The packaging fee is $1,500. So this ends up to the whole project cost of $1,125,000. Okay. Now jump in here. Then we're assuming a seller carry of 10% in this, which is pretty typical for an SBA loan. That gives us $1,025,000. Now the SBA is then going to loan 80% against the $1,025,000, so that's $820,000. So the borrower's down payment is going to have to be $205,000 or 20%. And so there's your breakdown to get to the $1,025,000. So we're going to talk about the leverage that you get from that in a second. So again, we're just kind of working through the terms to kind of see what the loan what you're getting for your $1 million business. So SBA loan term of 10 years, fully amortized, and this prime rate, the SBA interest rate is much less than 6.25% right now. So remember that if you're looking to buy a business, it's gosh darn cheap at this point. So
hey Dave, could you ask the lenders where they're at right now?
Well, you could do it. Go ahead, guys. Arvid, what do you want to?
I apologize. Would you rephrase the question again real quick?
What's the SBA interest rate today?
It's anywhere between, the rates have gone down quite a bit, obviously, but anywhere between, we're probably quoting anywhere from 3% up to 6%, depending on the product, depending on the structure, level of risk. So it varies. If there's real estate involved, there's different pricing as well.
Renee, do you want to make a comment?
Hi, Dave. I'd love to. So prime rate right now is 3.25%, And I can tell you that I have a loan that was just approved for a transportation company. So it's a 10-year loan, asset only. And the interest rate that's fixed for 10 years is 3.9.
Okay, money is cheap.
Yes.
Right now. That's a good thing. It's very good for all of us right now.
And I also wanted to make a comment that right now, so if you close on an SBA loan between March 27th, 2020 and September 27th, 2020, the SBA is covering 6 months of loan payments. It's not.
We'll address that later on, but that's very relevant. That's 5%. That if you're getting your loan, you're getting 6 months forgiven, or a holiday, or abatement, whatever you want to abatement.
Yes.
It's free. You're getting it's very, very attractive. If you're in the market today, keep your head down and keep pushing for it, because money is very, very attractive right now. So now I'll go back to this is 6.5%, 6.25%, I guess is pedestrian, but anyway, so your loan payment to the SBA is $9,207. Now the seller carry is typically a 2 to 5 years, so we put 5 years in here at the same rate. It doesn't have to be, but typically, if I'm going to pay here, I'll pay the same amount. So the seller carry here of almost 2,000 or 1,945. Monthly payment for everything is 11,152 times 12 is $133,823. Okay. Moving on. Now here's the reason we went through that arduous process, really is to show you the leverage. So this business generates $400,000 in cash, SDE, cash flow. You've got a debt service to the SBA and seller of $133,823. So that means that you have available immediately while you buy a business versus build it. You're set for salary, for CapEx, if you have to buy cars or trucks or whatever to support the business, pay taxes, and for return on investments of $266,177. So for your down payment of $205,000, you have a cash flow available to you, free to you, of $266,177. Now you step back and say, okay, this is where the assets come in. In this process, the furniture, fixtures, and equipment is valued at $250,000, inventory of $150,000, leasehold improvements of $50,000. And don't forget, working capital is part of the deal, is part of what SBA has loaned you. So your purchasing power right out of the gate is $550,000. Okay. The lizard. So if you step back and say, so if I was going to start this business with no customers, I wouldn't have the $550,000 I'd have to spend on those assets, and I wouldn't have the cash flow. So this is why SBA, why this program is good. You get a lot of leverage. The buyer for 25% down gets to buy this business. So for down payment of $205K, it gets the $266K immediately. And the seller gets 90% of his cash at closing, which is pretty attractive. He gets to walk away and go to Hawaii after his transition period. So there we go. So one of the things that we didn't talk about is seller carrying a note. And so interspersed in here is seller carry a percentage of it versus seller carrying a overwhelming portion of it. So why does the seller carry a note? Sometimes bank and SBA financing is just not available. I have a business for sale. It's a very nice auto repair business, and the seller wants one of his owners, actually two of his employees, to buy it. They don't have the credit, they don't have the cash to buy it, to be able to go through a bank. So he's financing it all. And so they'll pay him off over time. So it's a situation where there wasn't financing available for those specific people and where he wanted that business to be taken care of. The SBA, it many times will require a seller to do a carryback, really kind of keep their feet kind of they've still got, skin in the game, if you will. Not all sellers require it. Not all deals require it. Again, is back to Renee's point of looking around. You can get in situations where you don't have to do a carryback, but it's pretty typical for a 10% carryback. Sometimes, just for flexibility, as you're trying to strike that deal, as Suzanne said, you need creativity to get these deals done. Sometimes you can carry a note to get the best price. When I bought my business, that was what the owner had to carry it because he wanted a fair amount of money. I said, okay, well, we can do it this way. It's a way for a seller, by the way, to defer taxes instead of taking that $1 million up front and giving Uncle Sam his money immediately. You can carry the note for a few years and defer the taxes as the money comes in. From the buyer's side, you have no applications fees, no loan fees, so it's cheaper for the buyer, a lot less paperwork for everybody. The term is typically shorter than a 10-year SBA loan. 2 to 5 year term is more typical. The one thing for a seller, I will tell you, is that it absolutely will be subordinate to the SBA loan. That means the SBA gets paid first if anything, goes wrong as we go forward. So with that, were there any questions? Do you have any questions, Suzanne?
Yes, we're going to have to go back a couple slides on the one question. Hang on. Is it here? Okay. The question is, does the principal portion of the loan payment, here the example is $133,823, is to be paid out from the post-tax portion of the $400,000? I'll
Okay.
answer it if it's confusing.
I'm not sure you follow the question, so go ahead, answer it.
Okay. So the loan payment of $133,000 and change is both interest and principal, and obviously the principal amount increases as the loan progresses through its history, and it is everything is done pre-tax in these. So this $400,000 SDE is pre-tax, and the how you run your business and how you run your taxes will influence it. You need your accountant's opinion here on how do I depreciate my assets and things like that. But yes, if you notice, it says available for salary, CapEx, taxes, and ROI, $266,000. That $266,000 will be reduced depending on the purchase price allocation, which is a subject we're coming into in a minute or two, on how you allocate it and how you do your taxes. And the interest part of that $133,000 will be a tax deduction. Hope that answers that. Got another question. Don't you pay the loan principal after the taxes? My answer, am I answering that? Okay.
Go ahead. I was just looking at
Um,
the question, everybody.
The loan principal payments come out of your bottom line. Does that answer that?
Yep, I think so.
Okay, here's another one. When the owner carries a portion with SBA lending, does the SBA manage the loan for the owner? So that's a lender question.
No, the lender does not handle the payment.
Oh.
The borrower is responsible for making those payments directly to the seller.
Okay, and then another lender question. How do earnouts work into the structure of an SBA loan? Is that thought of as part of the seller carry?
Earnouts are not permitted. If there is an earn down, then the lender would need to approve the earnout. And there are a lot of SBA lenders that will send that directly to the SBA for them to opine on and not use their preferred lending authority. So check with the lender on what will be acceptable in there. I can tell you that I'm working on a deal right now where it's for a CPA practice, and the buyer and seller have in the seller note agreed to a reduction in purchase price at month 12 post acquisition and month 24 post acquisition if certain metrics are not met, and that was approved. So again, it's a case by case.
You know, we are probably negligent that we're talking about earnouts and didn't define them. And for those of you that aren't familiar with the term, an earnout is a way to pay for the business based upon future performance of the business, either a percentage of sales, a percentage of the gross profit, or a percentage of the net profits. One more question. How often do you see private finance / hard money loans being used to finance the purchase of a business?
And
non-SBA loans.
oh, non-SBA loans. So commercial loans, basically, is what you're saying. So not very often. But it would have to be where it does come up is where the business is very, very asset intense. And in fact, where the cash flow is having a tough time, it's minuscule compared to the actual asset value in the business.
And I think they're also thinking hard money referring to outside lending sources, investors. That's not much of our universe either.
Yeah, it's not much. It sort of fits into that strategic purchasers, where there's money's coming from private equity and things like that. So it's got to be a much larger business typically than what we have.
I work with a hard money lender in Miami. We're called LV Lending, and we typically don't provide financing for the purchases, but we provide loans based on real estate, on properties. And so depending on the size of the business and if there is any real estate involved that is owned by the business, then we can lend against the real estate. But it's just not typical of what we do. Basically, it's not typical of buying a small business. We're able to do it if there is real estate behind it, and we'll lend against the real estate. But it's just not our typical loan.
Okay, which answers the question we've danced all often. Okay. So at the end of the day, the finance, to buy a business, it's buyer cash, it's, you know, it's a bank loan, it's a seller note, and typically it's one, you know, one from each column. And virtually always it's you know, there's at least two of the three that are part of the deal. So here's where we certainly want to have the lenders involved. But let me go through this a little bit. So, and we talked about virtually everything here. So the SBA is currently log jammed. And I think even when we had the break, the lenders were talking about the huge number of loans that are being processed compared to what the SBA typically does with some of the government programs. But it's going to be a little while before we can get the SBA's attention fully back on the 7A and the 504s. And things are changing constantly. So, you know, the Congress is talking about more incentives to drive the economy that could distract the SBA again. The next thing is, and there's some really nice programs that are in place. We've hinted about them, right? There's no fees. There's a 6-month payment holiday if it closes by September 27th. The SBA is guaranteeing 90% to the banks, which makes, you know, takes less and less risk out of, you know, banks for BBVA and US Bank and those and everybody else. Financing is never going to be cheaper. But one of the things that we are, to emphasize again, there's a lot more scrutiny on the buyer experience, you know, for running this business and the cash reserves that this buyer can call on if something doesn't go right. And this is not just because of COVID. It's where there's uncertainty, you know, back in 2000, you know, 2007, 2008, 2009, you know, where the economy was a little iffy. There was a lot more focusing in how much can we rely on this buyer to succeed. So if he's an employee, that answers that question pretty easily. So Suzanne, can we turn the lenders back on for some comments, maybe?
Yeah, I think it would be great if for any lender comments and buyer questions. Okay, we got a question for the lenders. Is the SBA allowing for renegotiates of interest rates on existing 7A loans?
Yes, the lender that you have your existing 7A loan with, you would need to call you would need to call the servicing department and request a rate modification. The lender will most likely be asking you for updated financials, some tax returns in order to do that. And please know that it may take a little bit longer than it traditionally would, because all of the servicing teams right now are being inundated with the requests. But yes, it is allowable.
Another sorry.
Just to expand on that, this applies not just to SBA loans. It is discretionary per your lender, but other lending platforms, not including SBA, such as conventional loans, commercial real estate, can potentially have deferral availability. So I would check with your lender on any type of business lending product you have out there.
Another lender question. Are the guarantee fees reduced to 0 for all 7A acquisition loans now?
No, not as of now. We are hearing talk that maybe in the next round of stimulus that is on the table, but as of today, SBA guarantee fees are included in the loan.
We've heard some rumors some lenders are waiving fees. Is that true?
That's lender specific. You'd have to talk to individual lenders about that.
Okay.
Hey, David, it's Vic.
Yeah.
I've been waiting for this last stimulus, and I've not heard that they're waiving their SBA fees and 90% guarantees. Is that new?
This was, this is, everything's dynamic, but these are, we've been through some calls on the SBA programs, and this is what we've been told. We're hoping that you guys can keep us grounded to reality.
I've not heard that yet, so I've not been promoting it so far.
That's been, Dave, that has been discussed, but it is not approved yet. The only program that does not have any guarantee fees is the SBA Paycheck Protection Program. There's no guarantee fee, and it's 100% guarantee to the banks. There have been no changes to the 7A guarantee fee or guarantee percentage to lenders as of today. Senate is reconvening again later this week. There's going to be voted on some additional provisions, so we'll keep everybody posted. But as of today, no changes to the 7A. The only thing that came out of the CARES Act regarding 7A was that loan payments for existing SBA, for all existing 7A and 504 customers, that those are being covered by SBA for the next 6 months, and that anybody that closes on a loan between March 27th and September 27th, payments will also be included in that payment relief. That's all as of today.
Thanks for that clarification, Renee. As we look at that, that can be 5% of the loan cost.
Yeah, it's pretty amazing.
Yeah, just wiped out. Okay, lenders, this is the time. Anything you think that's important that we should know, please speak up.
I think right now, one thing that I'm talking to all the prospective buyers that I'm working with is, I think it's really important for everybody to address when they talk to banks, how the business that they're looking to acquire has been affected by COVID. What's the impact? I know we're not going to know what the impact is for probably another couple of months at least, but be prepared to talk about that and be prepared to have some really good analysis behind that. And year over year monthly financials, I think, is very important now for everybody as well.
Go on.
So I want to add to that as so how's it been affected? Obviously, it makes perfect sense. But the other side of it is there's been a lot of discussion at the doing businesses.
Dave, sorry, you're breaking up there.
Yeah, you froze. Dave, you're frozen, so I'm going to jump in. On our slide, the bank guarantees, the reason we have that on there, lenders, is we had a deal pulled from us. We thought that the guy was, it was at 75%, and one of the reasons we thought this particular lender pulled it was he could get to the 90%, started over. But should this slide read 75 or 90%?
It should read 75% as of now.
Okay.
Correct.
So then what gap between pledged assets and loan value is allowable for SBA loans? That's another question.
So SBA is not an LTV lender. So it's not like it's not like commercial real estate. It's lenders have to take all available assets to the extent fully collateralized. So unless there's commercial real estate involved, if commercial real estate's involved, we're looking for an 85% LTV. But if there's not commercial real estate involved, there's no LTV requirement.
We have sold what are called airballs, businesses with not one shred of tangible asset, and gotten SBA loans.
Yes.
We still have more of the program to go, and there's going to be a little bit more COVID discussion, but are there any other lender questions at this point? Okay.
So you're on.
Thank you, all the lenders. Thank you, Dave. Okay, I'm on. Okay, there's been some questions coming about the differences between stock and asset sales. So let's talk about that. Oh, we didn't start the video back up? Okay. Okay. So what is an asset sale versus what is a stock sale? Let's start with buyers usually want the asset sales and sellers usually want the stock sales. And let's find out why. The girl's going to win in this. Okay, in an asset sale. So if you have a legal entity, which you have to have, if you're a sole proprietor, you have the choice of selling asset or stock. But if you are a sole proprietor or you have to do an asset sale, and if you have a legal entity, you can do either. But in this case, you sell certain assets of the business. The way we have been valuing businesses is with the cash, AR, AP, and debt excluded, all the working capital excluded. That does not mean that that can't be part of the deal structure. Some of your questions have alluded to that. Taking on the receivables and payables is a way to finance a deal. Taking on debt is a way to finance a deal. And I think we're going to see more of that in the future. And this goes into the creativity part. So we sell it without the sales. There is a sales tax liability in asset sales on the purchased assets. And so what that means is if I go to the store and I buy a computer, I pay a sales tax on it. When you buy a business under an asset sale, subject to certain conditions, you are going to pay a sales tax on those assets. And I'm going to get into that a little bit more. There's what's called a step up in basis, and it's limited to this purchase price allocation. So the buyer gets to, the buyer gets to start an entirely new balance sheet. The sales tax, the taxes on the business sale are dependent upon this purchase price allocation. I think somebody out there, a few of you might be C Corps. C Corps have double taxation. First, the business itself gets taxed, and then those proceeds are distributed to the shareholders and it's taxed again. So this is when you really, really want an experienced team of deal makers, attorneys, accountants, and brokers who know what they're doing. Because there, as always, there are tricks to the trade and it can make a huge difference in the taxes you pay. Anyway, the reason that buyers want the asset sale is that the contingent liability stays with the seller. So let's just say I'm a bar and 2 weeks before closing, I overserved a customer and they go out and they get drunk and they get in an accident. At the time of the sale, I don't know that this happened. Well, if you buy the stock, technically that liability transfers with the business. So that's why the lawyers on the buy side scream and tell their buyers never to do this. Okay? In an asset sale, in spite of the fact that the liabilities are not supposed to transfer, certain liabilities do follow the assets. Sales taxes, payroll taxes, and personal property taxes. So if you buy the business and you buy it with no note and no escrow, you give the seller 100% cash and he or she didn't pay these taxes, they're going to come after you. And that's why we usually see that. And in the due diligence process, usually the buyer tries to ascertain that these have been paid. So stock sales, they do occur. And what happens here is you are selling the stock. It's no different than having Apple stock. And then usually you're selling 100% of it, but not necessarily. For you balance sheet people, It usually includes the entire balance sheet, including all the working capital. It usually includes the money in the bank account, the receivables, the payables, all the debt, etc. In reality, it doesn't work that way. Larger companies, these middle market companies, tend to run more as independent, professionally managed operations. And small businesses, as we've said, owners who've had it a long time, they can build up a lot of cash in their bank account, for example. So we did a stock sale recently and the business had excess cash. The excess part was given to the seller, but the buyer assumed the amount that was determined necessary by working capital calculations. There's no sales tax paid on those assets, so can save some money there. But the buyer also does not get a step up in basis. They take the balance sheet as it is. And in most mature businesses, the assets are virtually depreciated to zero. So they don't get to write off any, they don't get much depreciation. They don't get the goodwill write-off that a buyer will get in an asset sale. The reason sellers want it, it's capital gains tax rate to the seller, the lowest tax rate that there is. And so that's great. And as we said, the contingent liability transfers to the buyer. We actually have a really great accountant who focuses solely on business sales. And if you need to know the different, the tax ramifications for the different structures, he'd be happy to calculate that for you. So you say, why would anybody do a stock sale? Well, contracts, like leases and licenses might not transfer. So Dave already mentioned to you that he used to have an outdoor recreation business and he had contracts with all of these different BLM and national parks and all these things. So that's a way to transfer them. Tax mitigation for the seller, we mentioned that. Sale of a partial interest. Let's say I want to sell you half of my business. This is the way I'd typically do it. Or sale of patents, intellectual property, etc. Another reason is if a seller is very lucky and gets multiple offers, he might say, I'll take the person who will do the stock sale, and might get it that way. In any case, if you're going to do it, get legal and accounting advice. Were there any questions on that part? Okay, this elusive purchase price allocation we've been talking about. It's required in asset sales. The purchase price needs to be allocated according to the defined asset classes from the IRS. Two parties are both going to file this form 8594. We're going to show you an example with their taxes the year they buy the business. The seller's taxes and the buyer's beginning balance sheet are determined by this, and they have to match, and the IRS actually checks that they match. So here are some of the allocation categories. So furniture, fixtures, and equipment, FF&E, we talked about that existing in a business, and it is subject in Colorado to sales and use taxes, except in manufacturing concerns. So if you're selling a manufacturing company, you need to break the assets out, figure out the value of the manufacturing assets, figure out the value of the non-manufacturing assets, the office equipment, the vehicles, etc., and then you'll pay taxes on those. Inventory at cost and WIP are part of the allocation. And prior to 2018, usually there was no tax on inventory. However, in 2018, there was a tax law change that allowed you to totally write off all of your inventory at one time. If you did that, anything you put toward inventory is going to be taxable. Another category is leasehold improvements. As Don told you, businesses invest in leasehold improvements into facilities in spite of the fact that they are owned by the landlord. When a restaurant opens from scratch, typically about 2/3 of the cost will go into leasehold improvement. So those are the tangible ones. Then there's a number of intangibles. If you buy a franchise, you're going to pay a franchise fee up front. That will get allocated. Training and familiarization. In a business sale, it's expected that the owner will transfer the reins of the business to the buyer. They will introduce him to the employees, the customers, teach them how to run the business, introduce them to the vendors, etc. That is usually part of the purchase price. Often there will be a consulting agreement on top of that. And that is usually if the seller is going to be involved in some way. We just had a sale where the seller said, I've always wanted to pursue this avenue of business, but running the company, I was just too busy to do it. Let me do that. And if I generate any revenues or whatever, pay me some money for that. And they agreed to do that. In C Corp sales, this is also a tax avoidance issue.
Hey, Rebecca, I'm waiting on that document. Is it coming?
I'm sorry?
Switch on.
Somebody say something? Okay. Covenant not to compete. It's usually expected that the seller will give the buyer a covenant not to compete. That has 3 elements to it. It has an activity. So what can the buyer do, or seller do? What can the seller not do after closing? What's the geography that they can or cannot do that in? And what's the time frame? And you'll notice the last category is called business, trade name, and goodwill. This is meant to be the catch-all after everything else has been categorized. So let's look at our deal and see what it looks like with that. So the deal we just showed you, the $1 million purchase price, as you recall, it had furniture, fixtures, and equipment of $250,000. It had inventory of $150,000, leasehold improvements of $50,000. We didn't tell you it was a franchise, but they paid $50,000 for a franchise fee. The seller agreed to train the buyer after closing, and it's going to give 100 hours at $100 an hour. So is that right? $10,000. There's a consulting agreement for post-closing for $10,000. They're going to give a non-compete for $10,000. And you're thinking, that's wildly low. And you're going to see why it is low. And the balance went into trade name and goodwill at $470. And that sums to $1 million. So the reasons for those numbers are going to become evident on the next slide. Okay, for tax purposes for the seller, furniture, fixtures, and equipment are subject to depreciation recapture. So we had $250,000 allocated. The book value, I'm making up a number, is $100,000. So that means $150,000 has to be captured, depreciation recaptured at ordinary income rates, a very high tax rate. The inventory, assuming that it was not previously expensed, has no tax implication. The leasehold improvements are also, just like furniture, fixtures, and equipment, it's depreciation recapture, except that the write-off period on leasehold improvements is very long, anywhere from 15 to 39.5 years. So quite often businesses will have book value remaining on leasehold improvements. Now for the intangibles, if a seller has written off part of his franchise rights, they have amortization recapture. Same thing as depreciation recapture, except it's for an intangible. The next 2 categories, familiarization and training and consulting, are both earned income to the seller. That's your highest category. It means depreciation, or it means ordinary income plus it means payroll taxes. So you can be hitting 50% taxes on those two categories, which is why sellers hate them. Buyers like it because they get to write them off usually right away. Non-compete is ordinary income, so a high tax rate. That's why we put such a low number there. Now, tax or case law has said if a seller violates a non-compete, it does not mean that the damages are limited to what they paid. So if this buyer can prove that there was $1 million of damage by violating the non-compete, they'll get more than the $10,000, most likely. And the best tax rate is the business trade name and goodwill. Why we put the most toward that, long-term capital gains. We've run the numbers on these, and it really matters more for the seller to get the allocation than it does for the buyer to get a better allocation. It's like a 6-to-1 ratio. We have actually suggested to buyers that we will take a lower purchase price if we could determine the purchase price allocation. What's the question? In most states, isn't there an exemption for sales tax for buying most or all of the assets? Very astute. Colorado, to my knowledge, is one of only 2 states that have the sales tax. Okay, here's what it looks like for the buyer. Okay, so the buyer gets to take that furniture, fixtures, and equipment of $250,000 and put it on their balance sheet, beginning balance sheet. So let's just take a 5-year average and assume straight line depreciation. The buyer gets to write off $50,000 for 5 years for the first 5 years after they buy the business because of that. Inventory just goes on their balance sheet as it is. Leasehold improvements, we picked a 15-year period. So we had $50,000 allocated to leasehold improvement. That's $3,000 in change, another tax write-off. The franchise rights are 15 years or term. So we have had accountants disagree on this. We're in the 15-year camp, but it's whatever your own accountant says. So $50,000, another $3,000 in change write-off as amortization, not depreciation. The familiarization and training are during the term that they occur, so it's usually that tax year or the next tax year. Consulting agreement, again, is the term of it. And non-compete and business trade name and goodwill are both 15 years, which is why for a buyer, if they've got the protection of if the seller violates the non-compete, that they'll get more. For the buyer, it should not matter if they give the seller more in goodwill and trade name. But we had, what, $480,000 allocated to that. So what's that, 30-some thousand dollars a year more of write-offs. So I'm going to say something here. This is my own comment. Accountants believe the value of money today is greater than the value of money tomorrow, which is true. However, I think they're penny wise and pound foolish. So I'm going to tell you my peanut butter sandwich story. So we're Coloradans. We like to go hiking. So when we go hiking, we don't eat our peanut butter sandwich in the car at the trailhead. We make it last throughout the hike. When we get to the summit or the lake, we enjoy it, and then we nibble on it on the way back. Well, if we eat the peanut butter sandwich in the car, which is what the accountant wants you to do, my opinion is you have nothing left for later on when you've grown the business. Usually your write-offs in the first year are greater, so why take them all then when you think you might be growing the business and need them later? Anyway, enough soapbox there. Here's what the Form 8594 looks like. There are 7 asset classes. For you people who are balance sheet people, if any cash transferred in the sale, it'd be class 1 cash, and that amount would go there. We rarely see business sales with investment vehicles in there, but if that's where they'd go in class 2. If the receivables are part of the sale, they'll be in class 3, and that amount would be in there. For the purposes of our sales, class 4 is inventory, 150,000. Class 5 are all the rest of the tangible assets. So all the furniture, fixtures, equipment, vehicles, and real estate if it happens to be part of the sale. So 300,000, 250 for the FF&E, 50 for the leasehold improvements. Classes 6 and 7 are combined, which is stupid because they have different tax rates. So they put all the goodwill, the trade name, the non-compete, the consulting agreement together, and then you have to go to another form and take out the goodwill because class 7 is goodwill and it's at a different tax rate. But that's the government, and they're working hard now and trying to make it work. And this all has to add up to $1 million. Do some people do goodwill for a 10-year amortization term? Incorrectly, in my opinion, if they do it that way. It's 15. Okay. This was the detail on that. Okay, any more purchase price allocation questions? Okay, going to take you into the home stretch. We have some COVID-19 thoughts, and that's all these are, our thoughts, because we don't know what's coming out on the other side any more than you do. But we think, this is a new term, corona-proof businesses will be in demand. We used to talk about Amazon-proof businesses, but there's been some obvious businesses that have done better than others. I'm going to take the example of liquor stores, which are having a heyday right now. However, liquor stores had recently taken a big hit when grocery stores were allowed to sell beer. So in normalization, we are actually thinking we're going to have to take out these however many months of extra sales, because all it was a bonus for the seller. It's not the new normal. But buyers, we believe, are going to look at businesses that will, do better in hard times. Look at the left-hand screen. I'm not seeing anything. I'm sorry. Okay. Sorry. Thank you. Pause. Okay. Unemployment has increased. That's indisputable. We think that hiring employees might be easier in the future. A lot of sellers have been struggling with finding and keeping good employees. We already have heard the Restaurant Association said 14% of restaurants are not going to reopen. And my boyfriend is the kiss of death for restaurants. His 2 favorite restaurants have announced they're not reopening. But there will be people who don't have jobs, and we think there will be a lot of buyers who are wanting to or need to, quote unquote, buy a job. We also think there will be a new batch of sellers needing or wanting to sell. We've already heard of a number of sellers that said, well, I've been through the recession. I've been through September 11th. I'm too old. I don't want to go through it again. And some will just plain and simple not have the working capital to ride the wave. So there will be deals for buyers. The SBA is going to decide how to treat the COVID-19 affected SDEs. Lenders, any input you got on that or insight, or crystal balls?
Hi, Suzanne. Sorry, the question was about how COVID is going to be impacting the underwriting, or?
Well, okay, we're going to have businesses that have no income for some period of time, and we're going to have a lot of businesses that have reduced income. Historically, they wouldn't have looked well on that, but going into the future, we're thinking the SBA has to do something about that. I mean, the 2020 tax returns won't support the prices on a lot of businesses. And
Right.
historically, you had to have 2 years of tax returns that did. So, you know, you take a restaurant and somebody wants to buy it and they were closed for 3 months. We're going to have to decide how we're calculating SDEs into the future.
Yeah, I mean, everything is going to, we're looking at everything as a case by case right now. And it's certainly, we're waiting on additional guidance from SBA as to, you know, can we strip out the time and just look at the historicals and looking at the go forward and not the 30, 60, 90-day period. So that's all to be determined. But the only thing that I can say is that, you know, just everybody to be prepared to talk about how COVID is impacting the business. I was working with a buyer that was purchasing a multi-unit quick serve restaurant, and they're on hold now until June or July. And it's most likely the seller, they're already starting to talk about a reduction in purchase price and more seller carry. So I think there's just going to be a lot more discussions on how to get the deals done. And, you know, that it's just all to be determined. But again, answering the impact of COVID is going to be certainly necessary. And of course, there are some businesses that may not be tremendously impacted. We're seeing, you know, transportation companies that are not impacted, some construction businesses that are not impacted. So case by case for everything.
Yeah. One of the things I had talked to people like in Florida where they've had total disruptions before because of hurricanes. And they said that historically the SBA worked with them and kind of took that out of the mix.
Yes.
But we've never had experience with that. Another thing we think that the business rebound rate will be important. And I think it was you, Renee, that actually alluded to that earlier. And, you know, there are some businesses that probably will be back to normal in almost no time. And there are other businesses that are going to be really impacted. We've got a business right now that puts on events, and you know, that's going to take a long time. Big party bars around colleges, from what I'm hearing, they're not going to want people to be getting together in those kind of crowds for a while. So that'll influence it. But the one thing we know, increased flexibility will be needed.
Yes.
Any comments or questions? Okay, I'm gonna wrap her up, guys. Okay, if you're buying a business, the top price is usually for these kind of businesses, not strategic ones, but the kind of businesses we're talking about, it's a buy versus build. So a lot of times sellers don't understand that the buyer can go and just do some marketing or whatever and be at the same place that they are in a short period of time. That kind of determines what the buyer is going to pay. That's how the buyer looks at it. But a buyer should pay for a business based on how it's doing, but buy it based on what they can do with it. So remember the guy with the motorhome? He paid fair price for that business, but he was able to make it much more valuable because of his own energy, skills, insights, connections, etc. So if you own a business, why buy one? Well, it's kind of like marrying a lot of money. Can do it faster than making it, but it can be a lot faster than ramp up. You can eliminate competitors. A lot of times people buy a business just to get rid of a competitor. As our example showed you, it can be a lot easier to finance. You can leverage and you can include working capital in your loan or get it from the bank. A lot of times people buy businesses because of the existing assets. I think Dave mentioned the plant and facility capacity where it was, they had excess capacity. So a lot of times we see businesses that actually, we just had one actually, We had a 25,000 square foot facility. The business was distressed. The buyer was in the same industry, in a facility half the size, doing twice the sales, busting at the seams. So it was a given, a natural. In the recent past, buying people was more important than buying businesses in certain jobs, especially skilled people. A lot of construction people buying plumbers and electricians. They were buying companies to get access to good employees. Existing marketing channels. I had a coup in my career with this. Most of you probably know Udi's Breads. Well, way back when, Udi bought a little wholesale sandwich company from me. And what this company had was King Soopers shelf space. Udi couldn't get it. Anyway, it launched Udi, and he became a multimillionaire from this purchase. So, okay, when do you sell your business? Before burnout takes hold. Sometimes we get people that are just so fried that they can't keep the business running properly. Do it while it's still healthy and has upside. Sell it when financing is available. Remember the story of the software company? Do it while you can still enjoy your retirement. We've had too many sellers have very short or no retirements because they waited too long, or when other opportunities beckon. Suggestions for value improvement: increase profitability, that's a duh. Reduce reliance on the owners. Systematize and document your business so a buyer can come in and run it. Spend that money on professionally prepared books and clean books. Don explained to you the ramifications of pocketing cash. Have that product and customer diversity. I couldn't believe it. At one of these shows once, I mentioned a business. I said very little. I said it has one product and it's been selling it the entire time. And somebody in the audience screamed out the name of the business. We told you about when to get contracts, that commercial cleaning business that did it, and no one reported income. The visual that relates to this is, we've got to all be seeing the same thing. And we're going to close the show with Don drinking his Corona. Okay. Were there any other questions?
Unfair.
What's that?
Unfair.
I didn't hear it.
Unfair.
Unfair. Hey, it's Corona time, guys. It's 5 o'clock almost. We really appreciate your participation and your questions, and wish that we had been able to meet everybody in person. Want to thank the Jeffco Business Resource Center for helping put this on and sponsoring it, and thank all our lenders for all their contribution. We'll send you the lender.
Question?
Yes.
Yes, sorry for this. For a business, for example, I'm buying a business with cash which is under 50K. I'm closing using a contract which I downloaded from web. What do you say about this type of closing, which we don't go through a proper broker and just seller and buyer do it in this way? What are the risks involved?
I don't know that you need a broker. You've got, a price negotiated and you found the business. You probably should pay for a good business closing attorney, and we can give you the names of some of them. I have seen people do their own business sales with totally disastrous results. I had a guy once buy a retail business. This was not through us, and he did not engage an attorney, and he found out he didn't have the location. The landlord did not allow him to occupy the space the business was in. He made lemonades out of lemons. He actually went into wholesale business and did okay. But for about $3,000, you can get a business closing through a competent business attorney. And I don't know what kind of business or whatever, but that's my recommendation is do it right. I've seen I know of another case as well where they did not transfer the lease properly and ended up with some pretty serious problems.
Thank you.
Thank you. What is the typical down payment requirement for the SBA and under the new SBA guidelines? Do lenders want to jump in on that?
Every lender is going to have their own appetite, but typically you're going to be looking at a minimum of, regardless what lender, at least 10% cash on your own. And then there are going to be some lenders that want to see somewhere between 10 and 20%, but that 10 does need to come from the buyer, and the other 10 or more can come from a seller note.
Do they still have that option of 5% with the seller on full standby through the term of the note for the other 5?
There are a couple of lenders around the country that will do that, but it's not very typical anymore.
Okay.
And that's typical with some non-bank. That's typical with some non-bank lenders.
Okay. We like buyers to have skin in the game. We find they just work better. Can you share what can be expected in sales tax for a business purchase? Yes. Assuming it's not manufacturing equipment, the sales tax is typically whatever the local sales tax rate is for the amount that you allocated to it. So in our $250,000 furniture, fixtures, and equipment example, assuming it's not manufacturing equipment, it would be 8.whatever% here in Boulder, most Front Range communities. So what's that, $22,000 or $3,000? Another question? You can pull that picture now from Don Hobbs. Oh, Don. Anything else? Last chance, guys. Thank you so much. We appreciate it.
I had one question again, going back to my, sorry to insist on the retained losses of a business. If you're buying part of the business or buying the stock in the business, how do you deal with having these retained losses over, year after year, or having to just eventually generating enough income to surpass those retained losses, making them into retained earnings, so that then you can distribute dividends?
Well, okay. I hope I answer this correctly, and I recommend you talking to your accountant. But if you buy the stock of a business and it has retained losses, but you are probably coming in a different financial position. So if you're able to make the company profitable, they can still sit on the balance sheet as negative.
Okay.
Did I answer that correctly, other brokers? And I mean, you can sit with negatives on your balance sheet and you can use them per the advice of your accountant.
Okay.
Okay.
Thank you.
Wait, I got another question. No. Lastly, Amira, are you still on with us?
I am.
Thank you. Thank you for everything. Do you have any closing remarks?
No, thank you guys. I think that was excellent. Really, really great information. And for all the attendees, I will be sending out the post email, and it will have the handout and also the video that we did today. So the video presentation, I just need to process it. And then a few questions for survey. And we just appreciate your patience and you joining us today. And also, for those of you who are in Jeffco, we've increased our business advising hours. So if you or anybody you know is struggling on any level with anything related to COVID or their business, we're here to help. We've waived the normal six business sessions. Now it's unlimited till the end of the year because we want to partner with you and really walk through this to make sure that you resume your successful business. moving forward. And then also we have increased the number of business workshops that we're doing. So now our goal is to do 2 to 4 every week, providing you with just ways to maximize your downtime, the time that we're in shelter in place. And so this Friday we have one for all you inspiring authors out there. If you've ever considered writing a book, now is your chance to jump online. We have 4 people on a panel, 3 published and local authors, and then a gal who does editing and wordsmith. And we're just going to do an open Q&A about what that process looks like and how, I'm not going to say easy, because I think that really that's a pretty big endeavor, but it's absolutely possible, right? You can make that happen and you can bring your story to life. So that's on Friday at 12:30. And then we have a variety of other workshops coming up. Again, the goal is to promote 2 to 4. Oh, and then also on the COVID-19 funding, every Monday morning, we have an open Q&A. It's called COVID-19 All Things Funding. 10 to 11, we have our business advisor who's been working through this process with the business owners, and then also our partner from Colorado Enterprise Fund, a man named Jason. And so they're just doing just general Q&A, because as a lot of you know, it's changing a lot. The rules are changing almost weekly, so we're just doing our best to keep up with that and keep you informed. And I think with that, I just want to give another big shout out to Suzanne and her team. You guys were excellent. So thank you so much. We really appreciate our partnership. And with that, I think we all need to get out of the house, get up. We've been sitting here for a while. Let's go outside. It's going to snow, so let's take advantage of our last nice day. And with that, if I could just ask the presenters if you could hang out for 5 minutes after, and we'll bid all of our attendees farewell. Have a great day.
Thanks, and it's a great time to write that book.
Yeah, absolutely.
Okay.
All right. Thanks, everybody. Have a good night. Bye.
Okay, well.
Who is the wordsmith person for your seminar?
Her name's Alexandra O'Connell.
I have a friend who helps people write books. I was wondering if it was her.
Oh, yeah.
Kim is selling a ghostwriting business.